I think we can go ahead and get started. So welcome everyone to week 2 of the All Raised Seed Bootcamp. And we're gonna go through and do intros of our great panelists in a minute. I just wanted to give a quick thank you for everyone filling out the NPS. We had over 100 answers, I think, within a day. So I think there were a lot more after that. Niharika was going through and we read a lot of the feedback. And thank you so much. And we're going to try to incorporate a lot of it as we go to keep improving. As you know, the topic from last time was how to know if you have product market fit, how to find it more quickly, how to think about getting started with your seed round. I think today we're going to focus on the how to run a process and how to get intros to investors and how to set your valuation. And we have 2 VCs and 2 founders who are going to join us, and I'll be moderating. And I just wanted to set a couple of norms before we get started that a couple people emailed and asked about. So first of all, everything we talk about today is confidential. So it's fine for you to share on social media about, that you're in the boot camp or even like who the speakers were and that kind of thing. But don't share, explicit things that people shared. Nobody did this. People were asking about this norm. So, don't share specific things that people shared or, attribute questions from the chat to specific people or that kind of thing. We want to create a safe space for people to be vulnerable and share their real stories. Another quick update is that a lot of you talked about wanting to meet each other, and we are making a WhatsApp group. It'll be live by Friday, and we're actually going to segment people by sector and by geography. So, for example, there might be like a Bay Area consumer one or something like that, and we'll take into account to make sure it's like decently sized. I think there'll be between 25 and 50 people depending on the group. So hopefully you have a lot in common with people, and then you can go back and forth and ask each other questions and maybe meet up in person. And then we're also going to have, this was a common question, and I know we had mentioned it over email, but I just wanted to mention it quickly that we are planning to have an in-person event at the end. We're still planning the exact details. We'll definitely have at least one, and we might even have it in multiple locations. We're going to kind of look at where everyone is and decide if we have like it in 1 or 2 or 3 locations to try to accommodate as many people as possible. Okay, so I think that was all my kind of quick updates I wanted to provide at the beginning. So as all of you know, All Raised's mission is to increase the number of female founders and funders. And at the Seed Bootcamp, our goal is to give you all the fundamentals of raising a seed round so that you know how to run a process, how to get intros, how to make a deck, how to talk to investors and all of that. And then at the end, you'll get paired with a mentor to practice your pitch. And then if you're ready, we can also help with investor intros. So we really hope that it is helpful. And with that, I'm gonna kick it off with quick intros from the panel. And maybe if everyone could just share, if you're a founder, like, your name, your company, quick sentence or 2 on what your company does and your company size in terms of employees and funding. And so I'll introduce just to do an example. So I'm Felicia, I'm the co-founder CEO of Binti. We build software to improve the foster care system. And we are 34 people and we've raised $14 million.
I'll go next. Can you hear me okay?
Yeah.
I'm Edith Harba. I'm CEO and co-founder of Launch Darkly. We're a feature management platform with over 900 customers. We're about 120 people in downtown Oakland. Our most recent round of funding was we did a $44 million Series C, which we announced in February. But prior to that, we started 5 years ago, and we did a 400K, what we would now call a pre-seed round, and then a 2.2 million seed round, which I bundled together and just called 2.6 million seed, an 8.7 million A, and a 21 million Series B. So all told, we've raised about $77 million. And I'm excited to participate today because I definitely felt like the pre-seed and seed were the hardest for us to raise. So I hope I can be helpful.
Thanks so much for joining, Edith.
I can go. My name's Ilana Stern. I'm the founder and former CEO of Weddington Way. Weddington Way is a direct-to-consumer brand focused on the special occasion space. Sold it about 2.5 years ago now, actually, to Gap Inc. and left Gap last year to do some angel investing and advising. We raised about 20 million in venture capital. And when I left, the company we had about 135 employees, and we were at about a 35 million revenue run rate.
I'm Jess Lee. I'm a venture capitalist at Sequoia Capital. I've been here about 3 years. Before this, though, I was CEO and co-founder of a fashion community called Polyvore. We grew to about 130 people and about $30 million in revenue. We were acquired by Yahoo in 2016 for about $230 million. Over our lifetime, the seed ecosystem didn't really exist back then. This company was started in 2007, but we raised a $2.5 million A, a $5.5 million B, and a $14 million Series C, so $22 million raised total. And I came to the VC side because I was kind of pissed about how hard it was to raise money and how difficult it felt to be a female founder. So came over here to bring the light to the dark side. Yeah.
Awesome.
Hey, I'm Jess. Nice to meet you all. And Edith, I think I know the other panelists. Edith, I think it's the first time I've connected with you. I've heard so many good things about you. I saw somebody else in the chat was like goosebumps to like hear your intro. So that's just a fun little bit of serendipity. I am one of the general partners at GV. I've been there for a little over a year. So just starting to sort of institutionally invest at the Series A, Series B, and beyond. Before that, I was a pretty active angel investor. I co-founded a group called #Angels, where we wrote small checks into companies primarily at the seed, and occasions we would invest at Series A and beyond. I spent most of my career on the operating side. So I was at Twitter for almost 9 years, helping grow the company from a small startup, and actually participated in help craft a lot of our fundraising pitches for later stages of the company. So thanks for having me.
Thank you all so much for being here. Okay, awesome. So in terms of the structure, so I love all of the comments. By the way, I copied the comments from last session into a Google Doc so that I could read them later. And it was 140 pages. So you guys were super active in the comments, asking a ton of questions and writing comments, and I really appreciate that. To make sure that I can stay on top of it, I think that the structure will be that I'm going to ask, I have about like 5 questions I want to ask just to cover kind of the bulk of running a process and setting evaluation to the panel. And then I'm going to really shift my attention to the chat and try to like get through most commonly asked stuff there. So I'm not ignoring it, but we will get to it after my questions. So, first, my first question, I want to ask both the founders and the VCs. Maybe we could start with the founders and then ask the VCs to just walk us through, like, what were the basic steps of your seed fundraising process? Kind of like, what did you do first? You know, how did you go about, you know, deciding you were ready to raise, sort of like asking for intros and running a process? And then, like, so what did you actually do? And then sort of like, what do you wish you knew that you would suggest for someone to do it even better?
I can start. I think there's been a real stratification even more in the last 5 years between a pre-seed and a seed. And I think it used to be called an angel round and a seed. So I'm interested to hear what Jessica says. But I think it's really crucial to start first with angels and people with money to try to get kind of the initial, I'd say, 200K. How I approached this sounds really simple, but I made a list of everybody I knew that had money, kind of like Santa, but in reverse. And I coach a lot of people through my accelerator, and usually the response I get is, well, I don't know anybody who has money. I'm like, well, yes, you do. if you worked at Twitter, if you worked at Yahoo, if you worked at Google, if you worked at some company, like you knew the VPs and they have money they might want to invest. So just literally sit down, make a list, and then go talk to all of them and ask if they'd like to angel invest. And this really has two benefits. 90% of these people are going to tell you no, but they'll tell you no in a nice way because they're your friends and you can practice your pitch. So I had my ex-VP from TripIt where I was be like, Edith, you just word vomited. That was awful, but like, let me help you get better. You know, and same with an old boss from military. They're like, Edith, you know nothing about pitching. You need to like put it in this way, or, you know, actually go talk to this person. So that's really kind of ground zero of just like talking to your friends and families, honestly. And a side note is there's some people that didn't ask for money, and to this day they're like, well, you should have asked me for some money because now it would have been worth a lot more. So don't feel embarrassed to go talk to people you know. The next thing after that is that even if they don't invest, they know what you're doing and they can make intros. So like, you know, I went and talked to one of the co-founders of TripIt, and he's like, I don't really understand what you're doing at all. This is deep infrastructure, but go talk to this other person. He might get it. So that's me in a nutshell about getting started for your seed round. But I'd really be interested to hear what Jessica had to say because she's more of a structured angel.
Oh, Jessica, I think you're muted.
Saying, you're probably going to find us deferring to each other a lot because I'm always like, well, the founders always know best because they've lived this. I think Edith's point, and Jess alluded to this earlier, about the ecosystem evolving in a really dynamic way is true. So fundraising right now, there's a couple dynamics that are sort of changing by the minute. The first is that we're generally in a moment of a ton of capital that wants to find its way into early stage private tech companies. And if you zoom out, Jess alluded to, you know, seed financing her company many years ago, and that ecosystem was different at that point. And that means for the first time, you have a lot of the big institutionalized VCs are starting to play at the seed stage a bit, which is something we can dig into, and the trade-offs of doing that. And you also have a bunch of new entrants into the ecosystem, and you have a pretty rich angel environment. When we are not in such like rich times, that ecosystem will look and feel a lot different. But in light of that, I think there's no single best way to figure out how to raise that early capital. I think for some folks who have a really strong operating profile, maybe you're a serial entrepreneur, you're already well connected in this ecosystem, you might have the opportunity to skip what is typically referred to as like an angel or friends and family round, and you might go straight to institutionalized seed investors, a couple of the seed firms, or even maybe a VC firm. And for other folks, which is probably the vast majority of people trying to just get started with their business, you're going to have to sort of hustle and put together that early round of funding in however way you can. And so I'm a big fan of, as Edith mentioned, starting with your friendlies first. And these are the people that have bet on you and your career, really believe in you. Maybe it's a boss you work for, maybe it's the executive level of a company you were a part of. Maybe it's other people you've been fortunate to be in touch with through your career. I say all this knowing like raising through networks is just like the most privileged, you know, system in terms of having access to people who are ultra high net worth. But one way to consider that is like, think about every job you've had up until this point, you have been making money for someone else. So think about like who at the top of those companies had a lot of wealth creation because of the labor in that organization, and someone there is probably willing to take a bet on you because you were a part of the success of what they were building. So I think that's a great starting point. And oftentimes those connections will lead to more intros and a whole informal network of like the angels, you know, the seed investors, those firms all pass notes along. So I would just start with your friendlies first, and know that it's okay if you get a lot of no's. A lot of those end up in introductions or in folks that just want to cheer for you or perhaps are going to be a fit later down the road?
So I raised, I'm also sort of, I guess, speaking to a different time or a different era because I started Weddington Way in 2010 when I was graduating from business school. And the seed ecosystem also was not developed the way it is today. However, I think a lot of the lessons I learned would apply. We actually raised sort of the friendly round, I would say, our first 200K that we bootstrapped the business with. It was a mixture of some of my classmates from business school, some former mentors, actually some former professors from school, and raised our, I guess it's pre-seed would be called now, but then it was called a friends and family in like 4 tranches. The first tranche was like $30,000. I think the second tranche was like $45,000. They kept escalating in size. And I actually, I mean, I took checks as small as $5,000. It was from a really good friend of mine who I would consider a sort of peer mentor, who to this day was one of the most value-added angels invested in the company and the smallest check. So was sort of non-discriminating in terms of check size, and sort of the only filter I applied to friends and family was making sure I felt comfortable that everyone understood the risk level that they were taking and fully grasped that, since it is a high risk investment. The way I sort of catalyzed or sort of got the tumbleweed going from the first 30,000 to more was sort of everyone I knew I had ever pitched to had ever sort of said no. When I pitched, I basically started every month sending out an update of the progress I was making working sort of out of my living room, basically. And over time, I got more and more interest from people saying, hey, I'd like to invest. And there was just sort of this methodical drumbeat of me sending out an update every month saying, you know, what we had accomplished, what we had not accomplished, what I was planning to do next month. And then I would do it again over and over. And so people sort of saw a track record of me saying a mixture of I was doing what I said I was going to do. And then I was also taking ownership over the things I didn't accomplish that I said I was going to. And that gave me really good momentum to basically sort of roll on the first 200K that came in through an open convertible note. Which I guess today would be most likely a safe. And then the traction that I was able to build off of that investor base in the first 200K is then what gave us the leverage and momentum to raise the $2.5 million. And through those updates that I was sending out every month, the list got longer. It was, eventually I think possibly even a couple hundred people. And so it was, there were some classmates or friends who never even invested who were on the list who said, hey, actually, I know someone who might be interested. So then I started meeting with people, and that ultimately gave us the momentum to raise the $2.5 million seed round that we eventually raised. What I'll say with the seed round, and we can get to this later, that was an entirely institutional round without angels. And after that round, actually, I always was intentional about carving out space for angels because I found that strategic angels were really value add over the life of the company. But I think, in our selection of investors in the institutional seed round, I was very fortunate to have multiple term sheets in that round. I think a lot of it was built off the momentum of these updates, and I totally selected the wrong VC who gave us, it was a mixture of highest valuation and certain things I was looking for in references that in hindsight were the wrong filters. So I think in the Q&A, I'm happy to speak about that. But our lead VC was essentially, I would say, not, I think we were the only seed investment he made. And so it was just like a very uncomfortable stage. So I'd say there's nothing wrong with taking institutional capital for seed, but you want to make sure if you're taking institutional capital for seed, it's someone who gets the stage.
The tip on keeping the investor updates and sending them out just to show like you're the kind of person that does what they say they're gonna do. I think that's a really big tip. I think that's really important. So my experience, I didn't raise a seed because seed ecosystem didn't exist really in 2007. But right now Sequoia does a lot of seed investments. I just did one 3 weeks ago. Actually, that was a pre-seed. So first, like there's no product, pre-revenue, nothing, 2 people with a PowerPoint. But I would say the important thing for me at the beginning of every fundraise, no matter the stage, is get your story straight. Like you need to have a compelling story. And the other thing is, if you want to tell a story that's compelling, you kind of have to also know your audience. So Felicia, you'd ask, like, I could go back, like, what did I wish I had known? I think what I wish I'd known was I wish I'd understood a little bit more about how venture capitalists think or angel investors think. Like, what are you looking for? Why are you saying no to me? Like, I would have felt less bad about all the rejection if I understood the mindset of the VC. So I think it's okay if I talk just a little bit about that, Felicia? Okay, so now that I'm on the other side, I totally get why all these people said no to me, how I did like all these mistakes. So this is what I'd like to share. Like, as a venture capitalist, it kind of depends on the different stages. But, as a VC, you might make one to 5 investments per year. And over the course of your career, maybe somewhere between 20 and 50 investments over like a 20-year career, right? So you are looking for who are the 15 or whatever, 50 people that I want to work with for a really long time. And part of that assessment is not about like you, the founder, are you doing a good job in your space? Part of that assessment is also, do I want to spend time on this problem that you're solving? Like, who cares if you're even the best in this space yet? Is this even an interesting problem to me? So I was going out and like claiming to all the male VCs, like, we're a women's fashion app, right? And saying, this is the best women's fashion app, we're crushing it in our space. And I would get really offended when they were like, oh, we're just not, no. And part of the reason was they didn't care about the market. I hadn't done a good job explaining the market. Like, by the way, women are 50% of humans, 100% of us wear clothes. It's kind of a big deal. I just wasn't, that part like wasn't resonating. You must have faced the exact same thing being in the wedding space, but you really have to spend a lot of time in your story, not just explaining your personal story, which is very important, how your product works, but like, what's the problem you're solving and why is it a big and important problem? So the part of the story that I think most founders neglect is, what's the market? Not just like market size, some dollar number, but what's the problem you're trying to solve, and then how your approach is different. And so that's the part I wished I'd understood. I wish I understood that the VC was evaluating not just me and my product, but the entire space that I was in. And then I had to explain how important it was. So for any of you working on something where the investor or the angel like doesn't know this space, you have to take extra work to explain how compelling your problem is that you're trying to solve.
I also think possibly, sort of targeting the investors who are interested. Like, I met with an investor in New York last week who particularly likes, he's a seed investor, and one of his filters, he really likes investing, and he calls them toy markets. And it's basically markets that have big potential, but other VCs aren't taking seriously. And so I think there's some work that can be done up front in targeting the right investors.
Yeah. The framework I always use is at any time there's this tripod of team, dream, and traction. So if you're, to the earlier point, if like you just exited Google as a director, you can get a seed round, no problem. If you're not that, you're getting better at your dream, or you have to prove more traction. And so it's always just what you're doing at that time. And the one sense of hope I'll add to your comment is that your story will get better the more you tell it. Like, don't feel like you have to have the killer story like right out of the gate, because that's really paralyzing.
Yeah, to piggyback on that, something I did, I had the luxury of tinkering with ideas while I was in graduate school, so had a little bit more time. But while I was in school, I basically signed up for every pitch event possible, and so to that point, it wasn't all shining moments for me or moments that I could be super proud of, but just making myself vulnerable and putting myself out there a lot to practice pitching really helped me get comfortable telling the story and telling it in a more sort of conversational and native way.
Mhm.
And back to the dream point, like that dream, the other thing that I think I didn't realize about the VC mindset is, you know, as a founder, you're thinking about like, what am I going to do this week, next week, this quarter, maybe thinking out a year. Angels and VCs, as they're thinking about, is this a good business to work with? They're thinking like 5-10 years out. And so the dream you need to sell is not just like, here's what I'm going to be in a year or 2 years. You have to stretch yourself to imagine what the company could be in 10 years, right? Assume you have 1,000 employees and lots of money, just like at least painting the story of what that could be is actually really important. And sometimes I think that's the thing I see most commonly, a common error that female founders make is you don't want to overpromise because there's like it's pressure to be like perfect and like do a good job. And so you don't want to overpromise. So you just don't tell the story. And then men come in, they're like, in 10 years, I will do blah, blah, blah. And they sell some really big dream. And part of the evaluation is like, how big is this dream? So I think you do need to push yourself to sell that larger dream as well.
Yeah. And I'll just add on, like, advice I got that was really helpful was that, you know, eventually you'll get the money, but you want to find an investor that you like working with. I think somebody just said they had an investor that ended up not being the right fit. I mean, you were stuck with them for 5-10 years.
Yeah.
So like, if you spend all of this time like in a conversation pushing a boulder uphill trying to explain what you do, and they're just kind of like, I don't get it at all, it's not going to get better.
Yep.
Yeah. Yeah, and Edith, you shared the thing about not having the story right up front. I know a really helpful thing that I did in my process is sort of just, you know, practicing with other founders first. So like as you're, and we'll spend more time in the next session on sort of perfecting your pitch deck, but just, you know, like kind of my process was like, okay, first let me get my story right with other founders, then maybe like friendly investors, and sort of work your way up. And similar to what Edith shared, like I met with kind of smaller investors first, maybe ones that write 5 or 10K checks that I could practice on. And if I messed up, it's not the end of the world. Then I met with like slightly bigger angels and then funds. And so by the time I got to meeting with funds, I like knew my story. I knew all the questions. I knew how people reacted well to different answers. So yeah. But one thing I would like one warning I would give about a lot of practice is that I have experienced that it can also be a little bit demoralizing when you practice to a lot of people and everyone says slightly different things. And you practice with one person and they're like, you know, I think you really need to like say this on the first slide and like bring this back and don't say this. And then you're like, okay, and you make those changes. And then the next person like says the opposite. And that will happen, like 100% it will happen. And for me, it actually really shook my confidence because it was like, oh my God, like, I don't know how to tell my story anymore. Like, I'm just like not telling it well. And I had to kind of like take a step back and be like, you know what, I know how to tell my story. It's my story. I'm good at it. And I'm going to try to look at what are the pieces of advice that I think are like the most important and the most consistent. And then I'm going to kind of ignore the rest. And that's like maybe how they would tell it if they ran this company, but they don't run this company. So I'm going to say it this way. And like, I kind of needed to like be a little bit like, and then that was like very empowering and I felt powerful and confident again. But it really, I would just be careful because I think I've heard from a lot of people that can happen.
Yeah. 100%. Like I remember there was a stage when I was trying to get our seed together and my co-founder, who's my best friend from college, was totally blunt. He's like, Edith, you have gotten worse in the last 2 months. Like you've gotten advice from so many people, like you're not yourself anymore. So it's like karaoke. I love karaoke, by the way. It's like, you got to own your song, and what's a great song for somebody else is not a great song for you.
Yeah. Awesome. So, I want to dig in on like process a little bit more because everyone talks about creating momentum. Some people talk about FOMO. Like I personally actually believe that running a great process is incredibly important. And I think that great companies without a good process might have challenge raising. So I really want to make sure that everyone kind of understands how to create the best type process to make the process as fast as possible. So either founders or investors, whoever has thoughts on sort of running a tight process so you can make it happen, make people reach decisions quickly, and get back to building your company. What are your thoughts on that?
I mean, I think you're right, Felicia. I think Felicia's the master of this, actually. She did a really good job with her raise. Yeah. You should actually answer this question. But I mean, I think what you don't want to do is have a rolling window of maybe I can come in at any time. Like, you want to set a timeline because you got to run your company. You do not want to be spending months and months fundraising. And so you need to create as much as you can, a sense of urgency, and that there's like time horizon. So you need to line up your meetings in such a way where it's going to be exhausting, but you're like back to back to back meetings on a few days that week. And you front load the people who are like your practice people. And then at the end of the week, you put your like less like the people you're very, very seriously want. And then you try to move them and create a sense of urgency. Like, I would like the answer by this date. We're going to close soon. You want to share things like, oh, I have, a lead committed, and then you want to move it forward week by week. Felicia, maybe you should just share what you did, because I think you were the master of this.
Okay, I can share my thoughts. So I basically for my seed round, I raised it in 4 weeks. My Series A, I raised in 3 weeks. And it's basically what Jess said in terms of having meetings back to back. I think that like an important concept in fundraising is that investors would like to have as much time as you will give them to make a decision, because it's a risky company. You still have a lot to prove. And so if you're like, yeah, I'm kind of raising over the next like few months, there's no time pressure, they will want the next few months to keep seeing your progress. It only makes sense. Like, we would want to do the same thing if we were in their shoes. So I think that what you need to do is give this sense and make it a reality that this is actually going to happen pretty quickly. So you need to give me a yes or no answer now with the information that you have. I think that's sort of like the fundamental concept. So, and the way that you can do that is by having a lot of meetings back to back to back. And so what I did was for a few weeks, just meet with founders and sort of do that practice, but be careful about not getting demoralized, like I mentioned. So do the practice pitch with founders, get your pitch down. And at the same time, you're asking the founders, hey, will you introduce me to your investors? And you've just pitched them. And so hopefully they're kind of impressed and excited. And then they say, yes, I will. And then you send them your blurb, and then they send it to their investors. And then you start getting all of these intros. And then you say, hey, I'm actually kicking off my fundraising in 3 weeks. So don't take the meeting today. It's tempting to be like, yay, I got an intro, I'm going to take it today. But then you're going to run into this sort of sprawling process, versus if you say, I'll take the first meeting in 3 weeks. And then basically for like several weeks, you're just your own scheduler. All you're doing is lining up intros. And by the time you get to that point, you have like 40 meetings or 50 meetings or something like that lined up over the course of 3 to 4 weeks. And then,
what percentage of them are rejections?
Most of them, yeah, for sure. I think that most, even, the best companies that have gone on to be like the most successful, they get rejected most of the time. And so I think that's an important concept, is that it is a numbers game, and you can't just pitch 3 people and be like, oh, no one's interested. It's like, no, you need to pitch like 40 to 50, and then some of those will convert. And I think that the hardest thing is like getting that first person to invest. Like, once you've if you're raising 2 million, once you've passed the like, I have 1 million, I have 1.5 million, it's much easier to just like fill those in. But getting those first people is the hardest. And so I think in that first day of your meetings, saying something like, yeah, I'm actually just kicking off my process today or yesterday or whatever. But I have 40 meetings lined up over the next 4 weeks. We're seeing a lot of interest. So I think that we will close pretty quickly, or like, just something that gives this vibe.
Sense of urgency.
Yeah. And then once you finish pitching them, if they're an angel, they should either commit on the spot or within a few days. VCs have more of a process. And so angels, they might commit on the spot. If they don't, I think saying something like, awesome, well, it's Tuesday, can you let me know by Friday? I like giving 3 business days. And usually they'll say yes, because there's kind of no reason why not. And then on Friday, follow up with them. Also, like, send a good note that night of like the most important points. And then Friday, if you don't hear from them, follow up. Basically, you want to push everybody to be a yes or a no, and you don't want any maybes. Yeah, and then hopefully, you get some yeses, and then, maybe the next week you're like, yeah, I just kicked it off last week. I already have 100K committed. And then you sort of keep being able to say this, and you sort of create the sense of momentum. And like I said, I think like stacking people you're least interested until most interested, so that for the people you're most interested in, you're really good by the end.
Yeah, so I think Felicia, I mean, I think you've run your processes more masterfully than I ever did. But one thing I will add, something that I did at first unintentionally and then eventually intentionally, because I realized it helped create the sense of momentum, that I would add to that. I wasn't as good about the timeline, so I at times spent more time fundraising, so I wish I had done it that way. But what I would do is I would round up the non-term sheet writers before going out to the term sheet writers. So by the time I was going to people who lead rounds, I already had sort of momentum and commitment. So once I had sort of the angel group going into the seed round, I had a sense of which angels wanted to add in more capital and like sort of how much capital I had soft circled. And what helped catalyze our institutional seed round was a micro VC who didn't lead rounds, but wrote reasonably large checks, who basically said, it was basically an I want in at any price. Can you carve out like 700K for me? And so then when I went into my next meeting, I did have some meetings stacked and had that. It started to create some momentum. And then in following rounds did that as well, with just people taking their pro rata and sort of going and being able to speak to what we already had circled up before sort of pitching really to, I guess, new investors or term sheet writers.
Yeah.
Was that Edith?
Oh, I was gonna go, but go ahead, Jess.
I was gonna add two other just practical tips. Lean on your champions and market and advertise the yeses. So if people start to commit and they've given you a firm commitment, feel free. I get emails all the time which catch my attention when they say, we're raising this much, this price, these 4 people are in. There's a bunch of signaling that kind of goes on in this informal ecosystem. And if those are real form commitments, feel free to drop those in your notes. I think the other thing is you will find some people, whether they're firms or like super angels, starting to play bigger roles in the ecosystem. And sorry, I do mean name them. Yeah, I do mean like drop their names. You will sometimes also find these super angels or others who will want to syndicate your deal out to their network. So I'll give you an example. Like maybe first round is leading your deal, and first round might say, hey, are you up for us sharing this with a few people? I think we could fill out another 200K with sort of friendlies in their network. So as an angel, I will oftentimes get deal flow from VCs. We're leading this round. We want to introduce the founder to other angels in Silicon Valley. Are you interested? There's this much room left. And occasionally you will find super angels that do this as well. So like Alad Gill is a well-known one. So if you're able to find those types of champions, you can lean on them for helping fill out the round, and you can also market them. And as you progress, having more of those folks with those yeses early on mentioned helps just for signal value for the folks you pitch later.
I was going to add a couple of practical tips. Again, I'm an engineer. I'm big on lists. Timebox is process. Advice I got was you can either be a great fundraiser or a great salesperson and product person, but you can't do both at the same time because both will be awful if you're trying to like go pitch deals to investors and also go try to sell it to customer. So like I would have like a 6-month, the worst was a 6-month sprint to our seed when I was like, all I need to do right now is get the seed done. And it was epically painful because I was like, this is my job right now to get the money, but that's what I'm going to do. So I literally had a spreadsheet. people I'm talking to, it was a list of, at our seed round, I think it was 35 people and 32 said no. And when somebody gave me a firm no, I would take that row and I would put it in gray and I would put it at the bottom of the sheet so I never had to think about it anymore. Because otherwise it's just too depressing to look at the no's every day. But absolutely time box it. And something that was a hard lesson for us in our pre-seed, we had hoped to raise about, I think I had hoped to get around 750K in our pre-seed, and we ended up getting about 400K. And it was over the time box I'd agreed to with my co-founder, and it was just like, hey, we just got to get back to work. We're gonna call it quits at 400K. But have a clear view of what is the time you're willing to devote to this versus actually running the company. And it's not always the answer you want, but it's sometimes just what happens.
Yeah, and so you kind of just addressed this. I saw a couple of people asking, like, do you take time away from the company to fundraise, and do you do it full time? I personally did it full time, both times. Did you guys?
I said this is the 6 weeks or when I'm gonna go fundraise.
Yeah.
I did not, and wish I had.
Yeah, and
Full-time job.
What do you say, Jess?
Yeah, it can be a full-time job. It's too hard to split your time across two things. I think it's better to just focus and do it all at once as much as you can.
I agree. I think it's, and it is painful, like, because, you know, things start sort of happening at your company and you're like, I really want to be involved in that. But ultimately, if you have the money, you'll be able to come back and deal with it afterwards. So I think I'm a fan of full-time. Okay. Okay, so we talked a little bit about intros to investors. I think that's a topic people are really interested in. So I mentioned, like, the main way is intros from other founders that you know. I know, Edith, you talked about knowing people that you had worked with, and Jessica, you did as well. People you'd worked with that have money. Any other tips on sort of like getting intros to the right investors?
I think the early stage of the company is just about building awareness and telling everybody you possibly can what you're doing. I think there's some people who could get away with stealth, but that wasn't us. So I would just go out and tell everybody I knew who I'd worked with before what we were doing. And I saw something float by in the chat window about, like, how do you actually ask them for money? And so I would go have a half an hour coffee meeting with somebody I used to work with, and I would tell them about our business, and I would, ask them for advice. And it seemed to go well. I said at the end, and only at the end, it said, hey, we're putting together an angel round. Are you interested in investing? And then I would pause and, like, let them talk. Cause, like, your natural instinct is to be like, oh, and please invest, please invest, please invest. Like, you just pause and see what they say. And a lot of times they'll just say no, and they'll say, but I can intro you to so-and-so at this firm who does do a lot of investing. So, like, a lot of people might not give you money, but they can give you a good intro.
Thanks for addressing that. I saw that question as well. And I think the person said, asking people I know for money sounds worse than getting a root canal.
Well, the key is, and let me dig into that for a second. Only ask people who could afford to lose it. Like, I didn't ask my family for money because they don't have any money. And my mom would yell at me at Thanksgiving dinner for the rest of my life. So, like, ask, like, the legal term for an angel is you have to have over 250K annual income or over $1 million in assets. So, like, don't ask money from people who don't have it.
Yeah.
But you'd be surprised who might.
And I would add, I feel like Silicon Valley is, oh yeah, I'm not on mute. Okay. I feel like Silicon Valley is actually a set of cultural business norms more than it is a physical location. And one of the really wonderful things about Silicon Valley is people tend to be very generous with their networks, where even if someone's not going to write you a check, but they enjoyed the conversation, like, a lot of these conversations will open a new thread with someone else. And so there's just this sort of informal deal sharing and conversations and coffee dates and this just real dynamism around information flow And so allow yourself to just pull on those threads where one conversation turns into 3 other introductions. And I think someone had asked in the chat a clarifying question about something I mentioned earlier about mentioning the folks who are committed. And I did mean like explicitly naming them. So like, had you pitched me and I had committed, you would say, hey, we're raising this much. Jessica from Angels is in, and so are a few other folks. We're looking to close around in a few weeks.
Mm-hmm. Awesome. There's been a few questions about like not everyone, you know, is in the Bay Area or in New York where there's big ecosystems. So, you know, they might not have worked at a tech company that people have money or know a lot of founders. So, what are tips like do you recommend for those people to get plugged in? You know, do you think they need to move to one of these places? Do you think they can visit? What are your thoughts? And I think there's questions from people around the US and also some people internationally too.
I would say try to find your local female founder community, like just a support group of even like 5 women who are kind of business owners. Like that's so important. But I would also like do these meetings over Zoom, right? Like reach out to investors who invest, anyone who has invested in your city. Like find out who has done investments at the bigger tech-oriented companies in your city. Find those people. Some of them may not necessarily be in the Bay Area, and then just do a lot of Zoom meetings. And then join groups like this. Join like Female Founder Office Hours, All Raise, Female Founder Collective, hang out at the Wing or the Riveter. I mean, I think just be around women business owners, and you know, part of that networking, sometimes it feels like, networking is like waste of time or like annoying, or I feel introverted. I wish I'd done more networking. I'm very introverted, so I didn't. But just being around other women who are kind of in that same stage, it's so like soul nourishing. And then you do unlock these new intros. Someone says, oh, actually, my old boss does something in this area. And like, you just make these connections. And the other thing I'll say is, don't be afraid of cold emails. You have to write them well. They have to be short. They have to stand out in some way. You have to personalize them, but don't be afraid to send lots of them, right? And as part of the job of being a founder is like constantly getting like punched in the face by everything. So you just have to like build up that tolerance for like rejection, like failing. Like that's like part of the entire journey. You're like failing and learning because you're expected to like grow so quickly. So the more you build up that pain tolerance, the better you'll be prepared for like all the stages of the journey. You know, the entire time at Polyvore, I felt like a total abysmal failure and like I was doing terribly. And in hindsight, now I look back and I'm like, I wasn't actually that bad. I'm sure you feel the same way, right? But it felt like shit the entire time. And that's totally normal. So be around other people who are in that state, and everyone goes through things at different, you know, when you're in a low, someone else might be in a high and they can pull you back up. You know, just be around that crew as much as you can.
Yeah, I'll definitely piggyback on that. You know, speaking from a place of I am in the Bay Area, but I think one of the most powerful sort of communities for me was, it was a mixture of men and women. I was actually one of the first women, but there was just like an entrepreneur meetup group that I joined that met once a month on Tuesday nights. It was like 3 hours. Part of joining was it was a very high commitment group where if you joined, you promised to be there. It was a big time commitment, but it was just like a very vulnerable, honest, and open space where founders were supporting each other. And it wasn't all, you know, my company was venture backed. There were some venture backed founders, but there were also founders of, you know, all different types of business, just cash flow businesses that were bootstrapped, private equity backed businesses, all you know, businesses that were mostly financed by, you know, various like, you know, debt instruments. So it was a variety. And I think the whole imposter syndrome and just like the struggle, I think being part of that group was really powerful. And then even like non-venture founders actually had, you know, some people just had connections of like, oh, I know someone who might be interested in your business and able to help. Or so there were a lot of intros that eventually came out of that group, because it was also just a community of people who got to know me really well, and sort of and vice versa, and were willing to sort of intro me to their network because they knew me as a human.
Yeah, I love those tips. I think this notion of like finding your community, where hopefully this group is a part of that for each of you. The other, the other transition going on in Silicon Valley is aspects of this ecosystem, which operates so informally, have little like sprouts of institutionalizing, like Y Combinator and Demo Day is an example of like institutionalizing the process for raising a seed. They started to do like a Series A Bootcamp too. I think Atrium is starting to run cohorts. Like this community is a great example of a boot camp. And so you all are already super plugged in and like taking the steps to find those communities, get that advice, get the real talk. And where each of you live, perhaps there's a community to meet up. But the other amazing trend is that the ecosystem is evolving beyond Silicon Valley. Like there's no doubt, I think in anyone's mind, the several of us that are working in Palo Alto or San Francisco, whatnot, like founders are building amazing businesses all over the country. And in fact, it's basically impossible to bootstrap a company in Silicon Valley unless you are really privileged, you're a serial entrepreneur, or we're like fortunate to get venture funding out of the gate. It's just cost prohibitive. So all of us on the funding side are adapting to like this new global paradigm. And so I don't think you need to move to Silicon Valley. I think coming out for a week and getting plugged in is probably a good investment in building these networks. But I think being outside of Silicon Valley almost puts you all on the frontier in terms of like where the world is going.
Alicia, what percent of this group is outside the Bay Area? Is it like 50%?
You know, I can check on that maybe while you guys are answering the next question. I can look, but my sense is that my guess would be about 50%. Yeah. Yeah, I think I would agree with what everyone says. I think that like 10 years ago, it was more like you kind of needed to be in the Bay Area a little bit more, but it's like others are saying, other cities are really popping up, and it is getting so expensive here. So like the combination makes it more attractive in other cities too. And then I think that I think it can be helpful to come fundraise out here because there are so many investors, and they tend to even be more like open to risk and like earlier investments on better terms than other parts of the country. And then I just want to chime in that I really like the idea of plugging into female founder and founder communities. And we're going to talk in the last session about managing the emotional roller coaster of fundraising. But I think that this is a really important aspect of that, is having a community that you can talk to. And it kind of serves like two roles, because it's helping with the emotional side, which is like real. But then they can also introduce you to investors when you're ready, and like you can introduce each other to people. And so it kind of can help with that as well. Okay, so let's talk about how to set your valuation and how to decide what terms to raise on. Like, do you raise on a safe or price round? Maybe someone could even give like the 1 minute definition, rough like definition of those two and like what they mean. And then yeah, how as a founder do you decide, and then VCs, how do you think about valuation as well?
Does one of the VCs want to just talk about the instruments real quick? Or?
So my opinion on this is like the only thing that what matters most is actually who you partner with. And different people have their sort of preferred financial instrument. I actually think the financial instrument you use is not really that important. Some of them are faster, like a safe or a note is like faster to do.
Which is good because legal fees are significant.
Yeah, so lower legal fees.
Yeah.
But some of the downside is that you kind of defer the valuation till later. And oftentimes people miscalculate that all the discounts that they gave away add up to giving away a much bigger portion of your company than you had anticipated. So I think the actual thing that matters is who are you working with and how much of your company are you giving away? Like what percent of the company are you giving away? To me, that's like actually the important, like in all the terms and all the term sheets and all that, like that's actually what matters.
I totally agree.
Cool. And can you also just give a general description of what a safe versus a price round is? And it doesn't have to be like the textbook definition, but just generally kind of what is the difference?
A safe it's technically a debt instrument, correct? So I've invested in a couple safes now, but I haven't raised on a safe. I think it basically acts the same as a convertible note, which is technically an investor is giving a loan to the company, but it's structured so that it can convert into equity on a priced round. So I don't even know what the standard terms were, but back when I did some notes, it was like a 6% yield interest rate, and I think like a 20% discount on conversion to equity was standard for like a note, or I think now a safe is probably similar. There are like legal technicalities that I'm not going to explain about them, but essentially they're vehicles. Like the safe now is just sort of it was developed by Y Combinator, and it's basically just like a standardized doc that's sort of legally sound that everyone sort of trusts. So if you wanted to avoid legal fees and not maybe feel like you're not in a place yet, you haven't developed relationships with investors that could lead around, and you're going more the angel route, and angels don't usually lead deals or write terms, it can be a good way to go to just round up a small amount of capital that can later convert into equity when you raise a priced round. But as you know, as Jess and Jessica both said, I think the most important thing is definitely getting the right people involved, and experienced investors can help, and lawyers can help with like the structuring once you have people who actually want to put in money. And I will say after the seed round, when I didn't select the best investor for the company, in every subsequent round I chose the best fit investor for the company and not the highest valuation that I could get. So I would consistently, I mean, dilution is real and it matters because you need to own enough of the company to feel motivated. But having someone on your board and that you're sort of married to and building the company who isn't the right fit is a real energy drain for a founder. And so getting the right investors on board is really valuable. And I was sort of lessons learned, less price sensitive in subsequent rounds I raised.
That makes
Yeah, and I would just refer folks for if you want to read up on the safe, which was alluded to, Y Combinator came out with this in 2013, and so it's been institutionalized in Silicon Valley, and that all the demo day startups tend to raise off of a safe. They actually have, Y Combinator has great information online, so they provide you templates if you do want to use a safe or just familiarize yourself with it. Typically, these instruments have two important terms: a valuation cap and a discount. And occasionally, people will raise with basically no cap and no discount. That's for really frothy times and a deal that people are just like, I want in at any term. That's really uncommon. But there was a time, I don't know if you guys remember this, years ago, when like Yuri Milner, I think, had offered like, I think they were no discount, or they were no discount, no cap, safe to anybody coming out of YC. Anyway, they have templates for all of this and really good reading material if that's something folks want to get up to speed on, and we can circulate that link.
So just the trade-offs are safes and notes are faster and cheaper to do, but the big downside is what often happens is you say you commit to an $8 million cap or a $6 million cap, and then when the next round is raised, like you've actually been, if you're able to raise at a much, much higher valuation, like let's say 12 or even 20 million, all those other people still convert at 6 or 8. So you've given away now a huge chunk of your company, like much more than you otherwise thought. And so that's the big downside is like you, oh no, I diluted my company like 30% when I could have diluted less by just doing it different. So that's the big trade-off, and it's, just something to think through.
Mm-hmm.
But faster and cheaper to do, so that's also great.
I think I think it probably could depend on, it depends on the ecosystem you're in and the point at which you're raising around. Like when when I was raising off of, basically just like a PowerPoint deck and a twinkle in my eye, and there wasn't really a sort of built out institutional ecosystem, which could be sort of similar what it's like in a lot of other geographies that are like not Bay Area or New York. The note instrument, which is like the same as like a safe, was like just a really good way to round up capital that was sort of, it was just like very straightforward. The document is like a page or two long, so it's like very easy to read and understand for an angel investor, and pretty standardized. And there's rich sort of content online about exactly what the terms are and how they work. So it can be, if I think if you don't have access to venture capitalists or at the sort of early stages, it can be a good way to go.
I'll add that we don't always have the luxury of choice. Yeah. Our seed round was incredibly painful. I really wanted to get a lead investor and I couldn't, so nobody would give me terms. Like I actually went and asked everybody who'd already said they would put in like 200, 300 and said, will you lead? And they all said like, nope. And like I'm persistent, so I asked again and they said no again. So what I ended up doing was just sending out my own convertible note with a valuation that everybody's like, this seems about right. And then all the money started coming in. Yeah. So you can always just be your own lead if you don't have anybody who's stepping up to lead. And sometimes that's just what you have to do. Like the other thing is, I wanted a $9 million valuation. Our investors were like, no, it's going to be 8, 9 is too pricey. And it was like, okay, I guess this is what it will take to get it in. So it's sometimes just, it is what it is. And you can push a couple times, then accept what your valuation and terms are going to be.
That's a great point about not waiting for the lead. I think the approach that I took, I agree that it's not the end of the world. Like if you find the perfect investor and they want to do a price round, even if it's, it is more legal fees, but that's okay if they're like leading around and everything. It's not the end of the world. I mean, it will probably be like 20 to 30K legal fees. So it's substantial, but if you're raising a couple million, it's a perfect investor. It's fine, I think, in my opinion. But I think the thing of Edith, I think that sometimes people are like waiting for a lead and then they're not getting any investments because they're sort of like waiting on the lead. And I think that is, at least I didn't want to go like wait that route. So similar to Edith, I was like, you know what, I'm just going to raise on a note. At the time I raised on a note, now a safe is great. But basically I just like went out to angels and just started, I set the terms, like, here's the note. If you want to invest, sign and wire. They can sign and wire like that day. And you're just like collecting. And then if you find a lead, they can always do a price round and you can convert everybody into the price round. So I think that helps you get around the like waiting on a lead, nobody's led. And in the meantime, you're not able to like really start your round. Personally, I like that. But if you're really confident you can get a lead, you can sort of wait for that.
Yeah, I used notes for harder, like we did a bridge before our Series A to prove out something that we were sort of onto but hadn't fully proved out, and similarly like set the terms. And it was basically just a way to make sure there wasn't like the appearance of lack of momentum. Like there was a way to raise the money, the terms were set, and then people could just start rolling in and committing versus waiting for a lead. So I think sometimes it can be a good way to just create the momentum that you need by yourself without waiting for someone else to, or the first domino to fall, I guess.
Yeah. And replying to a few questions here, I think, so people talked about more of the role of a lead. The lead is the person that like set the terms and the valuation, and then they give you money, and then everyone else can come in on the same terms. If you do a safe, you don't necessarily need that. And so when we were kicking off our seed, people were like, oh, who's the lead? And I was like, oh, we're not having a lead. Like you can, like people are already investing on these terms, and, we're just having sort of a syndicate seed. And then, yeah, I like that response because that lets angels sort of just be like, okay, cool. I'm going to commit. I'm going to be part of this round. And then you can always get a lead that then gives terms, and your lawyers can handle converting people from the note into that. So that's okay. So yeah. And then I think that like if you're doing a pre-seed of like 500K, like you probably won't have a lead. Like you should probably just have a bunch of people on safe. So you probably shouldn't do a price round. Really price round should be for if you're doing like from a VC, at least a couple $1 million seed round. And then you'll do a price round for every round after that. So like your A, your B, your C will all be rounds because that's just what is typical. People also asked about bridge rounds. Like what is a bridge and what should be the structure of that? I don't want to jump in on that.
Well, Felicia, I saw like on the chat just a couple more questions about, just like, what do you like at the seed round, like when there's a lead, it's usually like the lead would usually put in at least 50% of the total capital. Like, how would you like it? Sometimes take a board seat, sometimes not.
Yeah, I think it's like, more just you're the biggest investor in the round, and the one that sets the terms. Yeah, that's how I think about it. It often is at least 50%, but not always. Yeah.
And some seed investors take board seats, some do not.
Yeah.
At later stages, leads always take board seats, I think.
I say mostly at the seed stage, there's usually no board.
Yeah, and I personally think you should push for not having a board at the seed and save that for later. Okay, people also asked about
did you want me to explain the bridge?
Oh yeah, go for that. Yeah.
So what's a bridge round? So we raised a bridge between our seed and Series A, and basically it's called a bridge because it's like a bridge to something. You can raise a bridge to profitability if you're not profitable and you're just like basically need $1 million, let's pretend, to like get to profitability and then self-fund. You can raise a bridge to a next round. So basically we had raised $2.5 million in our seed round. And there was something that we unlocked that was really powerful in our product offering that drove like really high net promoter score and much higher gross margins. But it was basically just like a very early test. And so we realized that if we could prove that out more, we'd probably be more successful raising a seed round and just be better positioned to raise a healthy seed round, get a good investor on board. And so I raised a bridge, which was basically sort of an extension of the seed, but it was just it was a convertible note, like a safe that would convert into the next round at a discount to the Series A price. And it gave us the capital we needed to sort of scale that test more and prove out that it was really working. And so then we went into our Series A in a sort of position of much more strength with a lot more clarity around what the Series A dollars would actually be going towards. Does that make sense? Or whoever asked.
I'll let them, how did you set the terms for your bridge was a follow-up. Oh, and someone also said, I heard bridge is a taboo term. Is that true?
Oh, I don't know. It's bridge. I think bridge is possibly, I think what matters is that the bridge is a bridge to somewhere. That it's not like just peddling, trying to not run out of cash or something, that it's actually additional cash that you're taking to get to some meaningful milestone that will put the company in a different position. And so I think a lot of it probably just depends on the storytelling, but I'm sure it can certainly be perceived negatively or can have stigma.
Yeah, I think bridge is, it's sort of like oftentimes it's a bridge to the next round. Like I didn't hit the milestones I needed to be able to raise that Series A that's a larger like $8 million, $6 million round. So I need a little bit like 500K more or $1 million more to be able to hit that milestone so that I can raise the large round. Often I think it could also be a bridge to profitability, which is I think great.
Yep.
So sometimes that has a little bit of a negative connotation. So other terms that I've heard are a seed extension. Or a seed prime or a second seed. So lots of naming things.
but do you really perceive any of them differently?
Sometimes I think of a second seed of
Yeah.
like, interesting, you know.
Yeah.
Like you said, it's about the story, it's about the founder
Yeah.
and the traction, right?
Yeah.
And it's sort of like, is this a good amount given where the company is, and sort of an amount that an ownership you'd like?
Yeah.
Yeah, I agree. I personally probably wouldn't use the word bridge. We did a bridge. We did a seed round, and then there was actually inbound interest from an investor, and I was like, well, this could help us get even further before the A. But yeah, I never used the word bridge just because I think it does a little bit. So I basically just described it as like, yeah, we had inbound interest from an investor on great terms, so we took it. Like, that's kind of what I said. So I think it kind of depends on how you describe it, as opposed to like Alana said, it's more about the story. Like, yeah, we had a lot of interest and we thought we could get even further before getting to the A, versus being like, we're running out of money, we didn't think we could hit the metrics for the A. Like, I probably wouldn't say it like that. Okay, so another clarifying question was about when you're creating a syndicate for a convertible note or SAFE. So typically you'd set your own valuation, and if it's a price round versus if it's a price round, you set the lead. So it's basically like, how do you come up with what to put in the SAFE in terms of the valuation, and also if you're looking for a price round, like, how does that discussion happen?
I can take that one, at least for our seed. So for our friends and family, we started at, and this isn't public, but I'll share it here. Friends and family, like the first 100K, we got in at 5 million. And then everybody after that, we put at 6. For the seed, when we started talking to institutions, I would float different numbers and I would talk to them. And my style is always, because I'm a former product manager, to always be in kind of discovery mode. So I would say stuff, so like when I went and talked to Bloomberg, who was thinking about investing, I was like, what do you think, what would you value a company or stage at? And they said, oh, probably 7 or 8. I'm like, okay. And then I said, would you go up to 10? I'm like, no, probably not. So it wasn't adversarial. It was just kind of like, hey, where do you think the market is? Mm-hmm. And so I went and talked to everybody that was kind of soft committed, who said, hey, we're interested. And they all kind of settled right around 8. And then I went back around because I'm greedy. And I said, how about 9 or 10? And they're like, no. But 8 is fine. And so that's basically how I did it. I will give you, and I hope you all get there, if you're doing a series A, B, or C, which is a price round, I will give you completely different advice. But this is for when you're doing a note.
Awesome.
In general, about how valuations are set, it's valuations are, in my opinion, much more a reflection of the market situations than actually how much value your company has created, right? Until you, public companies are valued based on a multiple of free cash flow or revenue, right? And that ultimately truly is how much the company is worth. How good is it at efficiently producing money and investing that back, right? So there's like real math that goes into that. And until you have revenue, and even if you do have revenue, your private valuation, as sort of dictated by the venture ecosystem, is kind of a made up number. Honestly, it's just totally a reflection of whether there's lots of money available and supply and demand. It's almost like just a pure auction, because there's not that many people who are giving you feedback. So I think that's an important thing to know. And the reason I bring this up is because I used to care as a founder. I felt like I cared about my valuation too much. Like, ooh, this is how much it's worth. And then when I finally switched from being a private company to trying to sell my company, I suddenly realized, and it was like a very harsh wake-up call, this is how companies are actually valued, on a multiple of revenue or free cash flow. And so when I had to make that switch, and I thought my company was like, oh yeah, it should probably be worth about 600 million because that's what the private market would have paid. Suddenly it was like, no, we're going to pay 10x revenue, and that is already very generous. So you probably face the same thing, right? And so I think it's important to know that valuation and how much your company is worth is it's not actually how much your company is worth. It's sort of a function of what the market is willing to pay at this moment for companies that kind of look like you. And you don't want to get right now we're in very, I would say, more frothy times. There's a lot of capital available. And so a company that's like, you could get a $20 million valuation. And then if the market corrects, or you need to need to raise a round in the bad times after sort of maybe there's problems with the economy, or if you have to sell your company, what you don't want is to have a valuation that's so inflated that you can't make that step. And then the next one is like a down round, or you have to sell your company for a lot less than your previous valuation, and then none of your employees or you make any money. So I just remember that valuation is a little bit of a vanity number. And I think the number that actually matters is percent dilution, right? So you give away $2 million of your company for 8 million post money, you're giving away 20%. So that the number that actually matters is the 20% or the 30%. And the other number that matters is how much money you need for the next 18 months, right? So if you think about that, that's how much you should raise next 18 to 24 months, ideally. And then that divided by the percent you're willing to give away is the valuation. So anyway, it's I really just think it's more, because I went through times of plenty and then 2008 where like everything fell off a cliff, like there was a recession and it was very, very hard to raise money, and suddenly I was like a much less valuable company overnight. And so just know that that's a vanity number.
Yeah, I always get nervous when I see, companies, I mean, it's also a little bit later stage, but let's say companies that are saying at like a valuation that's 10x their revenue, when you look at like public multiples, and if they were a public company, the multiples would be much more compressed, because you never want to see a company, like Jess said, take too high a valuation in the private markets that it wouldn't be able to live up to in an M&A situation or in an IPO. It can be a real problem.
I'll just jump in for like the early seed stage. You probably don't have any revenue, so your valuation is kind of all over the map. It's basically what you can get. There's really no metrics around it.
Exactly.
Cool.
But the seed institutional investors usually care about percentage ownership. So I don't know how you think about it, but oftentimes seed institutional investors will have a band of what percentage of the company they need to own for it to work for sort of their business model.
Yeah.
That'll influence the valuation they're willing to give.
Yeah. And so I think most companies give away, or your seed round is often anywhere between 10 to 20%. It's going up to 20 now. It's because some people are raising like $3 million seeds. So 10 to 20% dilution at the seed. At the Series A, it's often 20 to 30%, more like 20 to 25 these days. And then after that, it starts to drop to like 15, 10 at later rounds.
Awesome. That's really helpful. That was a clarifying question people asked. And someone said, what about the pre-seed? Are you saying like 10 to 20 for the pre-seed and the seed together?
Yeah, I would say it's 10 to 20 for pre-seed and seed together. Yeah, some of the pre-seeds are like, I don't know, 7, 10% still.
Yeah, the only other advice I'll add, because I mentor a lot of young companies, is don't over optimize too much on your valuation and dilution. Like 100% of zero is zero. Like, so I've seen people get really hung up on like, I want a 10 million valuation and this investor will only give me 8, so I'm not going to take any money. It's like, well, just get the money in the door if that'll help you hire the people you want to hire and build the business.
Yeah.
Agreed.
Cool. Cool. Well, we got through all my questions a little bit ago. I've been going through the questions now, so I'm going to keep pulling from there. Panelists, if you see one you're especially excited about grabbing, feel free to do that as well. Someone asked, this is a kind of a quick question. When you're raising, you have a lawyer. We mentioned it could be 20 to 30K in legal fees. If you do a price round for a safe, it'll be a lot less. You can kind of do it yourself, maybe with like a little bit of help from a lawyer. But are those paid by the investor was the question. And so you'll actually pay those after you get the money. Typically you can talk to a lawyer and ideally you can get them to defer the legal fees until after you raise and say, hey, like I'm about to raise, like, can you kind of work with me for free until after the raise? And then after you raise, you'll pay for all of the stuff for the round and also for like incorporation or other stuff that you've used them for up until that point.
Yeah, there are a couple of law firms in Silicon Valley that will typically work on deferred revenue. And I'm sure they're global. They're global for Gunderson, Detmer, Fenwick, and who else do you see a lot?
Wilson Sonsini.
Wilson Sonsini. Cooley.
Yeah. I'll add it's totally worth it to get all, and this is with air quotes because you can't see me, a real lawyer who understands venture.
Yes.
Like, do not try to do this with like your cousin's friend who does real estate law.
Yeah, that's
Completely
true.
agree.
Yes, I agree. Yeah, there's some stuff that you need to set up in a certain way, and it can hurt you later.
One thing that I was surprised by when we raised our first institutional round is our legal bills were like 20 to 30K, but then like companies in typical venture rounds also pay the investors legal bills. So it actually ended up being, I think, generally more like 50 to 60K. But you can negotiate the cost up front in the term sheets, and so on both sides you can have a cap in legal fees. And if like the VCs like go over their legal fees, it's sort of theirs to deal with their lawyers, whether their lawyers write it off or whether the VC firm pays the remainder. I have no clue how that works, but I never had a situation where anyone went over. You get a bill for exactly the amount that you agreed to pay.
Yep, that makes sense. Okay, another question came in about option pools, and yeah, can people maybe talk about how option pools come into play when you're raising a seed round? And advice on that.
Well, there's the perspective of, sort of what the role of option pools like actually is, which is to incentivize the people you need to hire to want to join you. And then there's like how it plays a role in dilution. So I guess the first part, usually the way, I guess I'd be interested in others' thoughts, when I set option pools at our different rounds, it was purely based on a hiring plan I presented of like, based on what I was trying to do with the round, here was the team I needed to hire against it, and here was approximately how much equity we needed to give away we thought to hire those people. And that was usually how we aligned with investors on the size of the option pool. I found that investors usually would rather round up on the size of the option pool than round down to avoid later dilution or whatever, to just have some cushion in the option pool for hiring. But in theory, it should just be purely a reflection of what the people you need to hire, the roles you need to hire.
Okay, awesome. Oh, go ahead.
I'll back up and say something very basic, which I saw floating in the chat room. This is all assuming that you've actually incorporated. Like to legally raise debt through a SAFE or convertible note, you need to incorporate it as an entity. Like these are legal documents that have real repercussions. So we were dirt poor at the time, so we at the time incorporated via Clerky, which I think cost us like $2,000 or $3,000, and that saved us a bunch of lawyer fees, but also kind of set us up where we were something that people could invest in. So if you haven't already incorporated, please go do so. Like it's just a really basic step. And when you're incorporating, you form a legal entity and you set aside options. So I think when we incorporated, we did I think it was 10 or 15%. And then we put my co-founder and me on actual vesting schedules, which was a good sign that just like, hey, we're a professional, well-run corporation and we've figured all this stuff out.
That's a great point. Thanks for mentioning that. Yeah, so for sure, if you're going to raise money, incorporate, also set up a bank account for the business. Sometimes that takes a little bit of, you don't want to like not be able to accept money because you don't have that yet. And then yeah, vesting schedule, that's so important. I mean, the typical is 4-year vesting with 1-year cliff. And I think there are some examples of people sort of not doing that, and then their co-founder breaks up and then the co-founder has 50%, and that can really like ruin your company. So it's important to have that vesting. Okay, yeah. Oh, go ahead.
The 4-year vesting with 1-year cliff. So what that means is like, let's just pretend you own 20% of the company. That's like your stake in the company, and it vests over 4 years. So you're vesting 5% a year. The 1-year cliff basically means that you're basically not vesting your first quarter of your total stock ownership until the 1-year anniversary of when your stock started vesting. And thereafter you vest in sort of equal parts every month, so 1/48. I mean, different companies have different vesting schedules, and it's different in the public markets, but privately held companies are mostly 4-year vesting, 1-year cliff, and then monthly vesting after that 1-year anniversary.
Yeah, and I'd also say this is a very good forcing function for you and your founders to talk about commitment and who owns what. Like, it's an awkward conversation, but get it as early as possible. Like, if I've seen companies really blow up when it's like, well, there was somebody who was working part-time, but they thought they were an equal partner, and then somebody was full-time, and they never really had a discussion until somebody wanted to invest about who actually owned what in terms of co-founders.
Yeah, that's a great point. Yeah, I think it's really important to make that clear. And then also, like, if anyone's sort of helping out, just have them sign a consulting agreement. You can get like some standard one, either if you're working for Multinsini or whatever law firm you're using, because then it just clarifies that, like, no, they're not a co-founder, they're a contractor that you're paying $100 to do this thing or something like that. So yeah, that's a great point. Okay, and people also asked about should founders pay themselves at the beginning?
I feel like that's a very personal sort of, it depends on your life situation. Like, if you can't afford to have no salary, like, you kind of have to pay yourself. But I would say the vast majority of founders probably don't pay themselves in the beginning, and then start to after they raise a little bit of money. I mean, they just don't have any money. Yeah, but I mean, only you know, like, personally what your like ability is to live without pay. I think it's a personal question.
It's super personal. I know because I was graduating from school at the time, I haven't looked into what different type of loan instruments there are, but I maxed out, I had access to just cheap student loans, like very low interest rate. And I would think in a low interest rate environment, but I basically maxed out my student loans so that I could work for a year without salary. So I mean, there are definitely different ways to get creative.
Mm-hmm.
But I think it's important. I think female founders have more of a tendency to be martyrs than male founders. Like, once you have capital, sort of not paying yourself market. And I think that can long term be a really bad idea. So it's different before you've raised, and you have to get creative, or when you've raised very little. But if you're raising money, I think it's important for founders to pay themselves market salaries for their roles, just as they would the people they're hiring, or just sort of in line with the rest of the organization.
Mm-hmm.
Actually, so I think there's a lot of perspectives on this, but I think you need to, you probably pay your employees some percent of market. Like, if you're very early, maybe you're paying like 30% of market because you can't afford any, and then later as you get older, maybe you're paying 60% of market. I think you should not pay yourself at a higher market rate than your employees. To me, that just seems completely wrong. For me personally, I paid myself well below my market, or what would the market, whatever percentage that I was paying the employees, because I felt like I had so much more stock. And I just felt kind of like bad using the money, because CEOs tend to get paid like more. And so I just kept myself pretty low, and then just didn't give myself a raise. I didn't take a bonus the way my execs did, just at the much later stage. And part of that was also because at certain points the company wasn't doing that well, so I just felt like it was not the right thing to do, to take like a bonus and pay myself properly. But again, I think it's a little bit of a personal question. I just say the boundary is like, you should not pay yourself. It just doesn't seem right to pay yourself at a higher market rate than the rest of your employees.
I completely agree with that. I think the sort of like flip side experience, like I did similar to what you did, but it was like, it was just very, very low. And then actually when like, this is like more, but like when I got pregnant with my son and realized like how much I would need to be able to pay a nanny to continue to work the way I work, I was like,
that's
shit.
a great reason to bring yourself.
I was like, I haven't been paying myself enough. And it was actually a board discussion. And because we were so early, the board didn't even realize what I was paying myself. And there was actually another female board member who, when she found out what I was getting paid, she was like outraged. We had just never discussed it. And I sort of looked with hindsight, and it was like this desire not to take from the company, but I took it to extreme. So I think it's a balancing act, and the pay has to be stage appropriate for where the company's at and how well it's doing.
Yeah, I totally agree about stage appropriate. Like I'll give some real numbers. For the first 6 months, my co-founder and I didn't take a salary. It was because we had made some money off prior jobs and saved it. So, but we went in knowing that. When our first employee joined, we wanted to get him healthcare. It was a condition of him joining. And I discovered in California, you have to pay yourself as a founder. So we paid ourselves $60K, which we considered kind of like stage appropriate at that time of, it's not a huge amount of money and it's, not terribly low. As the company went on, our investors were actually like, hey, we don't want you to stress about taking a bus down to Palo Alto versus being able to afford an Uber. So there's definitely corners you can cut when you're definitely worried about money all the time that are just not helpful for the company. But it's, when you don't have any money at all, you kind of have to do what you have to do.
That all makes a lot of sense. I paid myself at the beginning, like as soon as I raised a pre-seed of a few hundred K, I paid myself, I think like 30 or 40K or something, like something. And I had like, I lived in SF, but I had a lot of roommates, and I was able to sort of survive. And then, and then like when we raised, I think 2 million, I think I upped it to like 60K and then like 70K. And then we were pivoting and I lowered it back to 30K. And then I raised it when it was going better to 70, and like I've kept raising it. So yeah, I think what everyone says makes sense. Make sure that you can survive, make sure, but yeah, don't have it too high at the beginning. But then I completely agree with Edith. Like once you get to the point where your time is super valuable and you don't, like, you being stressed about money is going to hurt the company, then raise it so that you don't have to be stressed about money.
Yeah.
Okay. So this is a question that came in. I hear that team really matters. Does it matter if you are not from Stanford? I hear successful founders are from Stanford. Can people jump in on?
I'm not from Stanford.
I'm not from Stanford either, but I think, the point is sort of like, do you have to have this archetypal pedigree or whatnot, or like what, like, and I think we can broaden the question to like, what does a good founder look like, or how can you like kind of sell yourself as a compelling founder?
So I don't think pedigree matters. I think there's something we say here at Sequoia, which is that slope matters more than y-intercept. Like you have a founder that's like, this is like the axis of like how well you start off, like the Stanford educated person who like has worked at Uber for 3 years and knows a lot about growth marketing, maybe starts here, versus as someone, actually one of the founders I work with, she came here from Miami, she ran a brand, and she doesn't have any of the typical pedigree, never worked at a tech company. And so the person from Uber, let's say at Stanford, if they grow like this, versus the person who came from Miami, who is an underrepresented minority, who like didn't go to the fanciest school and has never worked in tech, if their slope is like this, like they will beat that Stanford Uber person like after some amount of time. So I don't look for where you start. I look for what your slope is. Like, are you the kind of person that grows like this or like this? I love that. Right? And so I look for things like, Frida Kapor talks about this a lot, but like distance traveled. Like, where did you start from, and then where have you gotten to in a certain amount of time? Like, if you started out very, very privileged and then you got to Stanford, like you grew up in Palo Alto and your mom was a professor, then you got to Stanford, that's very, very different from like you're an undocumented immigrant who like moved and then somehow made it to Silicon Valley, right? Like that's grit, so much more important, hustle, distance traveled, and slope. Other things I personally care about, I look for good storytellers. this is why I think getting your story straight and your pitch straight is so important. Like, your pitch deck is not just for the fundraising process. Like, the story that you tell and your ability to articulate it helps you with, you know, selling candidates you want to join the company. It helps you sell your customers on why you should use the product. It helps you sell to like paying clients, right? So your ability to tell a story, because a lot of times you just have a story and you don't really have, your product's not perfect yet, you haven't completely figured it out, but if you can tell a story and convince people to follow you, that's, I think, a really good trait. So I look for storytelling ability. I think those are the two things that matter. And then the last thing, which is less about the founder, is like the market. Is this an interesting and large enough market? So those are the three things.
That makes a lot of sense. I think it's like, use what you have. Like, yeah, if you went to Stanford, like you can talk about that. Like, you know, but if you didn't, and like Jess is saying, you've like made this like crazy progress in a short time, like use that. If you're very technical and, you know, like use that. If you're really good at storytelling, and I mean, ideally storytelling is kind of important across the board, but like kind of like whatever are the things that are your spikes, like speak to those and sell those.
Yeah.
Yeah, this is Jess. I'm so sorry, you guys. I had technical difficulties. I'm back on now, just with audio.
Yay.
I think the other story to lean into is founders are all about creating something from nothing. So if your personal story has adversity or has like, you know, low resources at different points in your life, that oftentimes showcases the tenacity and the work ethic and the creativity and the ingenuity that like allows for invention. And so I think you have to tell the story that's authentic to yourself. But if you're not someone that comes from a really privileged background or doesn't have all these prestigious signals around you in terms of university pedigree and whatnot, you can flip that on its head and turn this into like a strength of your narrative.
Mm-hmm.
Yeah, I think this goes back to what I originally said about getting people who already know you to be your champions. Like when you're starting to think about a company, go out and talk to everybody you know so that they will sing your praises to everybody they know. And there's a lot of stuff that you're doing awesome that maybe you don't realize.
Totally. Another question that came up is if you have co-founders, thoughts on how to divide and conquer fundraising, or should it always just be the CEO doing everything?
I have a really firm opinion that it should be the CEO. The CEO is the one that the investors want to meet. It's the captain of the ship. If it's somebody else, they're kind of weirded out. If you bring 3 co-founders to the first meeting, they're like, why are you all here? The only exception is if it's a connection through your co-founder. For example, if it's like the CTO from your co-founder's old company who knows your co-founder, then you both should go. But otherwise, I think it really muddles the message if like you send a COO in the meeting and not a CEO. But I would love to hear what Jess says.
I agree with you. I think the CEO has to be present. That's part of the investment decision, is like who's running the ship. And so you have to meet the CEO. I think it's fine to bring your co-founders with you. I think it's actually, but not if there's like four of them necessarily, but like I think it's actually good for co-founders to get exposure to the pitch process, because I think you don't want your co-founders to underestimate or not understand how tough the fundraising process is. So a little bit of exposure to that is good. So I would say like have your co-founder join for at least a few of the meetings to get a sense of what it's like, but they don't have to come to every meeting. It's fine if it's just the CEO, but definitely the CEO has to be there.
Okay, awesome. Okay. So I do want to address, like, some people are asking questions about, I mean, about it being harder to raise as a woman or as a woman of color. So I just want to kind of put that out to the group on what your thoughts are on that, like either tips or how people should think about that going in.
Yeah, the numbers are not good, right? Right now, at least. Part of it is there's definitely unconscious bias around like how certain groups should act or women are not aggressive. Like there's been Harvard studies that show that like men get asked about upside and women get asked about downside. I mean, it's there's a lot of baked in bias into the system. And so part of what needs to happen is we need to have more women and people of color move into the investing side of the table to help make the decisions. And that is something that's slowly changing. I would say it's come a long way since I was fundraising. Like there are more women in rooms, there are more people of color, but we've just got there's progress, there's definite forward progress. There's still a long way to go. It is, so there's hope, but it is tough, right? I think you have to have an even tougher skin if you're a woman, and you have to sort of know like what to anticipate. Like I always tried to have a huge appendix of like, for anyone who wanted like poke holes into this or that, I would have like, I'd think through what are all the like questions I'm going to get asked about risks and all that. And I would make a slide like risk mitigation, key problems, and then my answer for each of those. Here's a list of risks. Here is, what I'm going to do to mitigate that. So just making sure you look super on top of things. So even the metrics I didn't want to present, I'd have a slide in the back. So at any moment, if I got asked anything, I'm like, thank you for asking that. And then I would jump to the back of the deck to show that I really knew my stuff. One thing I've seen female founders do sometimes that's a little bit of a disadvantage, and part of it's just like societal, but like the pressure to be perfect, you don't want to overpromise. I already mentioned that, so less selling the dream. That's one thing. And then being, just having to explain a tough market. So this trick that I did for Polyvore was I'd walk into these rooms of men and try to talk to them about how they should like back an app that like helps women shop. And they're like, God, I hate shopping. Like, why would I ever want to do that? And so instead I tried to demonstrate the value of the market by being a little bit more memorable and then doing a little bit of a gimmick. So I'd walk into the room and I would take a stack of fashion magazines and I would like slam them on the table, like the September issue of Vogue. And I'd be like, boom, make a statement. And I would point to the magazine and I would say that one issue of the magazine, September issue of Vogue, makes $100 million in the month of September. Now imagine that on the internet, right? And then it would like wake people up. And so sometimes you have to use these like aggressive tricks. But those are some of the tips on my end, at least.
Yeah, and I guess speaking to that as well, it can be tougher, it can be frustrating, demoralizing, and certainly like I found that when I was focusing on the statistics, it was hard. I think what I found, like for me personally and some of my friends, one was really connecting to the community of founders. It was actually really helpful for me to connect to a community of like male and female and like just like mixed ethnicity and everything. And the reason that founder community was so helpful for me was that it was also helpful to realize like that the guys had trouble fundraising too. And like statistically, they're better off maybe than I am, but it was helpful for me to contextualize that like I wasn't the only one having a hard time. And then I think that there were other components. I think it's different for every person. I found that when I started like going down the rabbit hole of feeling upset or like, there were times when I was diminished in pitch meetings or whatever, I developed this chip on my shoulder that sometimes didn't serve me well. And so just like tricks, it's different for everyone, but tricks for managing your own psychology to sort of like go into these meetings in a way that sort of serves you and your company best. So for me, it was a mixture of like support community, and there were just other like mindfulness practices of like focusing on thoughts that serve me and trying not to on not, and then participating in communities like this now that are actually trying to change systemically the problems feels really empowering as well. So it's different for everyone. But I think like also sort of figuring out how to manage your own psychology and make sure that you have support through like the ups and downs. It's hard to be a founder to start with, no matter what. And then like when, when you face disadvantages, it can be really, really demoralizing. And so sort of like the support system and nurturing, I think, is really important.
We did Felicia actually worked on this, and we did this with Female Founder Office Hours. We did a survey of women of color. Felicia, do you want to talk about the results? I think it's actually important to know the types of biases that people have, and then figure out a way to counter them specifically.
Sorry, which part of are you talking
so
about?
It's actually on Frida Kapor of Kapor Capital's blog, but we did a survey asking female founders of different colors, like, what type of feedback do you get? And what was interesting, I think if I recall correctly, like certain groups, like Black women and then Latinx women were more likely to get like, oh, you're too aggressive. And Felicia, I don't remember if you had, and I think it was Asian women were actually told you're not aggressive enough. So my magazine trick was a good thing for like the perception of Asian women. So just, you kind of need to know a little bit about the biases you're coming up against, and then you need to find that support group, right? Like find the other, if you're Black, find the Black female founders, like build that like network of support to strengthen you. And then just like, remember, like, you're not just doing it for yourself, you're doing it for every generation of female founders that comes after, right? At the time, I didn't think of myself as like some pioneer for Asian women in tech. I was just like, I'm a founder, I have no idea what I'm doing, and it's really hard to raise. And then fast forward now, like it's happened to me a few times where I've met young Asian female founders who come to me, they're like, oh my God, I read about you, and you made me realize that it was possible to be an Asian female CEO. And I was like, oh, I wasn't like, I never thought I was being a role model. I was just like trying to survive. And so just know that, just think about that and like, try to have that like keep you going a little bit. Like you're not just doing it for you, you're doing it for the sisterhood that comes behind you, right? So just remember that. It's hard if you like kind of just have to pick yourself up off the floor, but just know you're doing it for everybody else too.
Yeah, and I agree on tactics up front on like counteracting biases. I found like I was a woman raising for a company that was like focused on weddings, and so there were often a lot of ways up front where I found I would not be taken seriously, and so there were certain, I knew my numbers incredibly well, and I would often lead with a mixture of like storytelling, but like a heavy like quant focus at the beginning actually to sort of get, there were just ways that I like tips and tricks that I figured out to make people take me seriously, like in the first 5 minutes, so I wasn't getting written off.
Yeah, I would add, I think it's been covered well here that I think the numbers speak for themselves. Like, no doubt there's still bias, discrimination, racism, like all of that, I think still exists in this industry, unfortunately, and more broadly. But there are these spaces and communities, and it will be different for each person. But wherever that moment is for you, where you just get re-energized, you know, pitching is exhausting, and sometimes just like surviving in this industry is exhausting. But whatever that like community is, or that like friendship, or maybe it's a group of female founders. I've even had moments like this where sometimes when I'm in rooms still to this day, mostly with all men, and still generally in like existing in the patriarchy, every now and then when like a woman comes in to pitch and it's just freaking awesome, it's just like, even for me being on the other side of the table, that's actually an energizing moment where I walk out being like, fuck yeah, she's like kicking ass, and like this company is going to succeed. And so for whatever that moment is for you, just making sure you're making space for that, because I think in general this can be, you know, it can be like tough to continue to have the energy to like fight the good fight every day. If you were just existing in the industry, add like building a company and being a founder to that, and it's just a lot of stress to carry. So just making space for those communities or those people or those moments that like fill you back up, I think is super important.
I'll add in my own thing, and I honestly found it exhausting sometimes to think that I had to make space for everybody behind me, and that was almost paralyzing. That I felt like if I did a bad pitch, I was letting everybody else down. So please just give yourself a break sometime, that you're human. If you give a really bad pitch to an investor until you know you're not spoiling it for all women everywhere, because that's like paralyzing of like, oh my God, I have to do awesome. The other thing is, You know, and we got so many no's in our seed round. I keep coming back to how hard it was. The people that say no are probably people you don't want to work with anyway. Like the people who are like, I just don't get this. I don't get your space. I don't get you. You know, that's it's really tough at the time because like you just want the money and you're like, just give me the money and we'll make this work. But in hindsight, they're probably not a good investor for you to work with.
Maybe that's a good thing to talk about, Felicia, like what to look for in investors.
Yeah, that sounds good. Maybe let me chime in on the topic, and then let's come back to that next.
Oh yeah, sorry.
Yeah, no, it's good. So yeah, I agree with what everybody said. I think having a community is so important, as others said, because then you can talk about that you just got turned down, and they're like, oh, I know I did too, but like, you know, go get them tomorrow. And if you can have that in your co-founder or in like your founder friends, that's really awesome. And also like in our bootcamp, we're trying to have panelists from different backgrounds that, you know, we can ask these questions to get different perspectives. And, you know, in the first one we had Zara and KJ and Robin from, and then, you know, so Zara and KJ are African-American founders and Robin is LGBTQ, and then, you know, Des is Asian. And so we're trying to have a mix, and we'll continue to have that throughout so that hopefully you can like get a feel for different people's experiences. And I just want to mention that I definitely was aware of the bias going in, and but I also see it as like there's so many different advantages and disadvantages that we all have. Like we talked about, like some people went to Stanford and some people are technical, and you know, some people are men and some people like you know, are really good at sales naturally or really good storytellers naturally. And so for me, I think I tried to think of that as like one thing, like, yeah, like, okay, I have, maybe there's some bias here, but like, I'm really good at sales. I'm really, really good at storytelling. I'm really analytical. I'm really good at numbers. So I just tried to think of like, I have advantages in these other areas over most men and over like other people, and just like trying to like get really confident about those things. And then I think what Jess shared about like counteracting maybe the average perception of women, I think not just the perception, but I think that naturally women, like it's been proven that women, like men overestimate their ability, and women slightly like underestimate. And so that can really hurt you when you're fundraising. So I think that is like the one thing to actually think about and maybe proactively adjust slightly the way you talk when you're fundraising. Because if a man goes in there and they're like, oh yeah, I'm totally gonna like build $1 billion company, and you're like being more conservative about it, about your projections and stuff, like that is less compelling, especially if it's a industry that was founded on men investors and men founders, like speaking the same language, and then you're sort of coming in. So I think just, you know, practicing, get feedback, and then make sure that you're really, you know, being aggressive, and don't make things up, but really go for the aggressive version of your pitch. And little things like the way you answer questions. Like for example, if an investor asks like, what is the average cost of acquiring a user? I think sometimes men would answer, you know, it's 5. And then a woman might answer, well, you know, I think it might be this, but we need to run more tests, or, you know, and it actually, she has the same level of certainty, but she's just being a little bit more humble about it. So just like being aware of those things, and you don't want to oversell or like lie or anything like that. But I think it's okay to just be like, yeah, we've run some tests and we believe it to be 5. Like, you know what I mean? Like, you don't have to undersell and sort of second guess things. I also did a similar thing to Jess. We bonded over this, where I had a thing where we do adoption paperwork, and I like brought an adoption binder and I like slammed it on the desk when we were pitching, and you know, it was like a room of all men, and I think it left an impression because like you know, they first round capital led our seed round, and later people that weren't even in the room were like, oh, I heard you're the girl that slammed the binder. So it left an impression. So, you know, you don't always have to like slam everything, but maybe, you know, just think of some way to be like I wanted to make it felt that like I'm in charge here. Like I'm confident. I want like your attention. Like, I don't know. It just like, it kind of like set the tone. as opposed to like, I'm this like meek person that's sort of in the corner, like, no, I'm like taking control. So whatever that is for you, maybe just think about that. And then Jess, you were saying what to look for in investors.
Yeah, it seems like worth talking about.
Yep. Yeah. Ilana, what do you think? You're shaking
What
your
do
head.
I think? So, okay, so I guess thinking about the seed stage, I think, the very early stages of like company formation, there's so much that's amorphous and unknown. I think in an ideal world, you're bringing on investors with whom you share an interpersonal connection. I think who ideally strike the right balance between being very supportive, but also very direct and honest with you, asking good questions. I think some of the people who added the most value as like investors and advisors to me over the life of the company, like a test for me was, did I come out of a conversation with them thinking very differently about at least one thing than I went in? So people who asked really good questions and helped me just have a different perspective, think about something in a way that I never thought about it before. So when I say like supportive, it doesn't mean always like patting me on the back. It was like having, developing a rapport where we both had the courage to be direct with each other, ask tough questions, but especially investors asking really good questions and helping you think about problems in different ways is really valuable. I think ways that investors can add a lot of value is by introducing you to other investors to help with subsequent rounds. So I think, getting a sense of like the investors network or, how involved they are in the future with fundraising can be really useful. And then particularly I would say with angel investors, so sort of institutional aside, I basically carved space for strategic angels at almost every round in the life of Weddington Way. And strategic angels means people who had knowledge in areas that were important to us, where I wasn't the most knowledgeable. And so actually one of the strategic angels that we had brought on, who I sort of pounded the pavement to get a meeting with, who didn't want to invest in the company, but ultimately, like due to persistence, was willing to meet with me for advice and then ended up investing at the end of the meeting, was a man named Bob Fisher, who's the chairman of Gap Inc. And so ultimately he actually was like sort of the pathway to our sale. But he was really knowledgeable. As brick and mortar, it was clear was going to be more important for us. It was just this whole world. We had been sort of more of a product and tech company, and so it was brick and mortar was less familiar for us. And so bringing in some people who knew and had really strong networks, for example, around like building out brick and mortar experiences and sort of that operational component was important. So I think finding people, whether it's institutional or angel investors who have some like expertise in areas that are going to be important to your business can be really helpful.
I think the three things I cared about that I think are important are, does this person get it? Mm-hmm. I think it's really frustrating to work with someone who's on your cap table for like possibly 10 years who like just doesn't get it. Mm-hmm. They don't understand at all your product, and so give you like weird advice. I sound like you may have had a little bit of that. I definitely had a little bit of that.
I definitely had that.
So I would just get this like weird advice, like, well, my wife said that you should do this. And I'm like, your wife is actually, 45 years old and totally not our target customer. And so it was just very frustrating to have to always have to translate what I was trying to do through this layer that he could understand. Yeah. And so one, I would say, do they get it? And do they believe? Secondly, someone that you can definitely trust. Or actually, so maybe that should be first. But there has to be some element of trust. It's hard to suss that out right away. Part of how you can do that is, references with other founders. And then third is like, can they be useful? And useful comes in different forms. One is like, maybe they have a great network, or maybe they have expertise in your space, like you needed brick and mortar support. Or maybe, honestly, sometimes it might be someone who doesn't necessarily look like an experienced like board member, but is like actually younger and earlier in their career, and then therefore willing to work their ass off to help you because they need to prove themselves. So those are sort of like different flavors of useful.
Yeah, and I can't believe I didn't mention the reference thing, because I mean, that was something I learned from experience. By the time we got to our Series A, with our Series A lead, I think I talked to like between 15 and 20 founders that they had backed. And I tried to index heavily to make sure a good chunk of those were companies that were zeros or sort of bad situations, to understand like the character, like how they behaved in bad times, not just not just talking to their winners.
Yeah, I completely agree with everything. And I would also just say that like, it is okay to have some investors that are kind of just money and going to stay out of things. I think it's really helpful to have some investors that are like, they give you money and they're really helpful. That's the ideal. But if you have like a bunch of investors, which I do, I have like a bunch of angels and then a few funds. It's like, I can't actually talk to all of them frequently because that would be just like a lot of work. So I actually really like it that, like I have a few investors that I really keep up with and kind of talk to them about big decisions. And then the rest of them, they're on my updates. They'll send me a nice note. Maybe they'll make an introduction every here and there. But they're just like positive, supportive people. I think what you don't want is people that are like, negative and like create too much work for you. And that's where like the reference or, getting interest from other people that they've invested in is helpful.
Yeah.
One perspective I agree with what everyone said. One additional thing to consider: oftentimes the investors can be really helpful champions for you to get to your next round. And so thinking about having someone in that group or a couple people or a firm or whatnot that's really great at feeding deals upstream. And that means that they're just experienced, or they've been in the ecosystem a little bit longer, or they're in those communities or networks, and they just like want to brag about your company, and they want to tell, the folks that they're regularly in touch with all about what you're doing, and that they're super psyched to be involved.
Yeah, I'll add on to what Jess said. I think the number one rule of an investor is somebody that you feel you have some basic level of trust with. If you don't have that, it's not going to work. If they don't understand your business, they're like, why aren't you doing daily deals for fish every day? And you're like, that's cloud infrastructure. The second number one job of an investor is to get you your next round. So I want to caution a little, because before we were saying you don't need a lead, you can just roll up money. If you do too much of what's called a party round, where you have a lot of people just throwing in 50K, 100K checks, but nobody who has a lot of interest in the company, it might be hard to get your next round. So definitely try to align at least one person in your seed round. You're like, this is the person who has the connections to get me my A. And I'll say even now, like we just did our C round, and I'm thinking about like, how can we get our D round?
That makes a lot of sense.
And this is where some of the higher signal, really well-regarded institutions, one of their biggest value adds is both their signal and their connections and networks and feedback to help refine what you need to accomplish in the seed to be prepared to go raise the A.
Makes sense. So I saw a comment and then a bunch of follow-up about something which, really upset me and upset a lot of people in there. Like one founder mentioned she had a male investor say like she wasn't a real founder because she's in fashion, and someone said that to her because she's in beauty. This resonated with me a little bit because I work in like a social impact space, and some people were like, you should be a nonprofit, which nothing against nonprofits, but I was like, this has a business model and I want to be a for-profit. And so anyway, I just want to address that. I think every founder hears kind of annoying things like this, probably more so if you're in certain spaces, but I really appreciated all the support everyone was giving and being like, ignore that guy and whatnot. I did something that, maybe is not like the most mature thing to do, but I made like a Google Doc of like a hater list of like people that were really rude to me. And I don't plan on like publishing it or anything, but it, you know, it felt like a little empowering to be like, all right, you're going on the hater list and like I'll look at this one day and like, you'll be wrong. But maybe other people have other thoughts, but I think just like this happens to everybody. I had some people, like one person say, my heart says yes, but my head says no. Because like they liked our mission, but didn't think we were gonna be successful as a business. And so like people are just gonna say things that are like, why would you say that? That's just like mean and it's just like not helpful. But just ignore it. Okay, and then okay, so another question. Okay, so actually several people have asked, can you cover the basics of like what is a cap table and what is a term sheet? So can somebody jump in on that?
I can walk you through this. A cap table is technically your capitalization table, and it's a legal document. It's typically a spreadsheet that shows the equity holders in your business. So someone previously asked if there were good tools to use here. I think Carta is quite good for cap table management. I can't remember if they have a free version for small startups. There's a number of, early on, you could just use an Excel spreadsheet. Typically your lawyers will also maintain your cap table. But at the end of the day, when your business eventually liquidates, if you are acquired or you go public, and I acquired companies for a long time, I would get the cap table of the company we were acquiring. And when we would be paying, call it $100 million to acquire a company, we would make the waterfall, which is how does that purchase price get distributed? And the cap table is the ultimate document that records who has ownership in that company. And so the first people that are paid back are debt holders. So when you think about raising a convertible note, or if any of you consider raising debt, one thing to bear in mind is that debt obligation sits in front of your equity holders. So sometimes you will find venture investors, or you'll find equity investors who are buying ownership in your company. You'll sometimes find them hesitant to have debt come in after them, because they will say, well, I don't know, let's say you've raised an A or a B, and you need a little bit of runway before you get to your C, or for whatever reason you want to take on debt. There are good reasons to take on debt, but sometimes you'll have venture folks that say, oh, we have to be thoughtful about this because that debt is going to sit in front of the equity stack. And then when it comes to paying out the equity, in a good scenario, all your investors hold preferred equity, employees hold common equity. In a good outcome, all of that is basically proportionately distributed. So if your employee owns one share and your investor owns one share, like that's all maintained in the way that cap table ultimately converts. You will sometimes find situations where companies will raise a bunch of money. Let's say you raise $20 million. That's $20 million of preferred equity because it came with preferences. And that preference is referred to as a liquidation preference. It's going to liquidate before everybody else. So every now and then you'll end up in situations where the cap table will basically condense in an outcome. If you raise $20 million and the company is being bought for 10 in like a talent acquisition, only the preferred equity holders, only your investors are getting that 10 million out. The common is wiped out, is the expression, which is like employees will not get paid in that situation. This could be the topic of an entire kind of lecture, but I think the key takeaway is your cap table is a document that who has ownership in your company. And you should just always remember that the debt is going to sit in front of the equity, and the investor's equity, which is preferred stock, sits in front of the common. So that sits in front of your employees. And you just want to be cognizant that when you raise debt and preferred equity, that you're in a position to build a business that's going to be of greater value. Because if you don't, those folks are going to get paid before you and your team.
Awesome.
Hopefully it wasn't too much. Anyway, that
was great.
Which is why I was warning about setting your valuation too high when you're private, because like when you actually go through an M&A process and people start to do math, like the debt people and then the preferred people get paid first. And so if you don't clear like the last, the amount that you've raised, then you don't make anything, which is terrible for all the blood, sweat, and tears you've poured into the company. So keeping your valuation reasonable is a way to protect like the price you have to clear for anyone to make money.
And the other important piece of the cap table to be cognizant of is the employee stock option pool, sometimes abbreviated ESOP and ESOP. And that's the percentage of the company that you're going to set aside to fund employee grants. And when you go on and raise a Series A, you typically negotiate with your lead VC about how big that should be and who kind of tops that up, like if it gets topped up before or after the round. But so typically your cap table is going to have the preferred equity, the common, which is the employees and founders, and then the ESOP, or the common equity pool for employees.
Awesome. And another question was, what is a term sheet? And I mentioned, or Edith, are you gonna? Okay, I can just mention really quick. It's just the terms that a lead investor is going to invest on for a priced round. So you don't have a term sheet if it's a safe or a convertible note. You just use that to invest. But if a VC is going to lead, they give you a term sheet, and it's basically has the valuation and all of the other terms on it. And that's kind of like a whole topic about what should be on that. And I think it's a really good thing to go through with your lawyer to ask sort of like what is market and that kind of thing with the term sheet. But yeah, and then you'll sort of negotiate that. Maybe you'll get multiple and negotiate, and then you'll sign it, and those will be the terms that everybody else comes in off of.
And the term sheet is sort of like an executive summary. So it's like highlighting what the key terms of the financing would be. And then if you accept a term sheet, then the term sheet sort of serves as the outline for the actual like funding docs, which are often, a term sheet might be like 2 pages and the funding docs might be like 90 or 100 pages.
Ours are Sequoia, it's a 1-page term sheet, and the terms that matter are the valuation, how much money is being put in, how big the option pool is, liquidation preference, and then what the board structure is. So do you have a board? How many seats are for you, the founder, versus the investor? Liquidation preference is a little bit of a tricky one. So as Jessica was explaining, the preferred stock gets paid before the employees. You do not want you want a 1x liquidation. Like as a founder, you should try your hardest to insist on that. If an investor has a 3x liquidation preference, it kind of means that they get paid 3 times before everybody else gets paid when you convert to M&A or IPO. So that's like, it means they're guaranteed to get 3x as much. And so you do not want that. But sometimes it ends up happening. Like if you're in a bad fundraising position, like you're in a down round or you can't raise money anywhere, some firms will ask that in return for taking on the risk of funding you, that they get a liquidation preference. So this happened to me recently with a company that's actually doing very well, but the valuation jump is so big that they wanted more preference. And we felt that good about, we could still clear it in the long run, so we're okay with it. But, ideally you don't want that in there.
And if you feel a little bit intimidated by term sheets or cap tables or whatnot, this is where your lawyers will have a ton of experience in this. And the nice thing about the general Silicon Valley ecosystem is these term sheets and documents should be rather vanilla. As Jess mentioned, most of these term sheets are 1 page. Most of the industry has aligned on like 1x lick pref, stuff like that. If you were financing from late stage, if you had a growth company financing from a bunch of private equity firms, or that was going through some type of like partial buyout, like there will be all these unusual financial and legal terms, because the value is about like eking out that like crazy, little term that they got in there. That's not generally the cultural business norm for Silicon Valley. So don't be overwhelmed by this stuff, and you can always ask the lawyer should be guiding you for this.
That makes sense.
Well, actually, I mean, I'll just mention like something that was really a strategic decision and invaluable was um, the lawyer that I selected for Weddington Way was one who I really connected with. And I found he always explained things to me in English, not legalese, and felt more like a strategic partner than someone who was just scaring me about every possible worst case scenario. So I think, I don't know, especially if you don't know a lot of lawyers, there can be stigmas out there about lawyers, but lawyers can be just like incredibly valuable strategic partners to a founder to help you sort of like navigate the complexities of deal structuring and really understand what you're signing up for before you sign up for it. So if your lawyer makes you feel confused or dumb or whatever, not the right lawyer, like there are really great lawyers out there who will sort of talk and people speak, not in legalese, to make sure that you really understand what you're getting into.
That makes sense. And yeah, one other important aspect of the process, which Alana kind of alluded to with like that the term sheet is actually like a summary. And ideally the most important term should be in there, but like this is actually an important distinction between like doing a safe versus a price round. Is that like a safe, like you sign it, they wire, like you're done. With with a price round, there's a term sheet, you sign it, and then typically you enter diligence, which for seed is like very light, but it still is like a few week process typically, where they ask for like every, you know, all your incorporation documents, like every employment agreement you've ever signed, every consulting agreement you've ever signed, you know, like just all this stuff. And then like there's a few weeks of that, they're basically verifying that, you know, you have done the things you've said you've done. And it is very uncommon to sign a term sheet and then not go ahead and fund the company, but it does happen. And it does add to anxiety. Like when you're in that process as a founder, you're not fully relaxed because you've sort of signed, you're going to go with this person. You've told everybody else you're not going with them. And then if this person ditches you, you're kind of like screwed a little bit, because then you have to go and explain to other people, like, why did it fall through with that person? So it's like a very vulnerable position to be in, but because it's such a bad, like terrible, embarrassing thing to do as a firm, to like sign a term sheet and then not, unless there's something like fraud going on, you'll mostly be okay. But yeah, that there's the diligence process. You have to like go through the longer docs and then sign it. So that's just something to know that adds to the process. I was surprised how long that was and how involved it was as a seed founder.
I'll say it only gets more involved the further along you get, but just make sure you have all the basics down, like make sure you're incorporated. It sounds really incredibly basic, but I gave this advice to somebody 2 weeks ago, like make sure you're paying people. Like don't have a bunch of people working for you for free without employment contracts in place, particularly in California.
Yeah. Or consulting contracts.
Yeah.
Mm-hmm. Yeah, that makes sense. Someone said, is it illegal not to pay people? Yeah, it's very tricky, and like they could come back later and claim that they were like a co-founder, or that they should be paid something. So I think having some agreement in place, even if you're like, I'm paying you $100 for like all this work, is you want to have something documented that you had some agreement.
It's generally not worth it to not follow employment laws.
Yeah.
Yeah, I think the only other thing I've seen it come in with like M&A too, where you just want to make sure your ducks are in a row. IP issues can be like legitimate deal killers. So if any of you have been at like companies where you're working on some open source project and then you're wanting to take it and commercialize it, just making sure that those exits are done in ways that are really unambiguous, getting a lawyer to consult with you around incorporation. Those are areas that I think do matter for acquirers, who tend to do actually even more diligence than investors.
So someone else asked, will an LLC be okay, or does it need to be a C Corp? I feel pretty strongly it needs to be a Delaware C Corp. That's just what 99.9% of companies are, like at least in like companies that get investment, and it's just what everyone's used to. So there's just, and it's so easy to do. You don't have to be in Delaware. You can, it's like, there's really easy ways to do it online. So I would just,
yes, Stripe has a tool called Atlas, which has great for $150, I think you can incorporate, you can create a C Corp in Delaware, and they've got a ton of resources available. So it's a great reference point.
Awesome.
Some firms can't invest in LLCs, so you might run into that if you try to do an LLC. I agree with Felicia, like be a C Corp in Delaware.
Awesome. And then some people ask what is the recommended like size of the option pool at the seed round?
I think it's usually 10 to 15%.
Yeah. And this is a point of negotiation too. Like founders, I mean, you want to have enough to get you to the next round. So you don't want it to be like 2% and then you don't have enough to give to your founders, to your employees. But yeah, in general, I think like it adds to the dilution, like the bigger it is. So generally like founders try to do less, like, 10, and maybe investors will try to push for 15. So.
And then if you start to run out partway through the round, what you do is you just increase the pool size and get your board to approve that. Yeah.
So some people have asked about, sorry, where was it? Okay. How to, so a few people asked about scouts and like sort of what are scouts and like, do you recommend trying to get intros to scouts?
Sure, I can talk about that. So I think Sequoia actually created the first scouts program in Silicon Valley. And it was this idea of like, hey, let's spin up a group of people who we think would be great angel investors, like people who are mostly, in the beginning, it was mostly Sequoia founders who hadn't yet made enough money to start angel investing, but were very well connected to other founders. And so the Sequoia Scouts program, each scout gets $100,000 and then they invest in companies and they work together with one of the partners that works here to get approval on the investment. So that's how our program works. And then I think since then, it was quiet for like 6 years. And then since then, it's come out. And then a lot of firms have adopted. So I think Lightspeed has a Scouts program, Benchmark, just a bunch of, and it's just a great way for a VC firm to extend their network and build stronger relationships with people they think are awesome, who would be good angels, as well as to see more investments in more companies, keep tabs on more folks in the ecosystem. Scouts normally write smaller checks. It's not exactly the same as getting money from the firm because you don't get the full resources of the firm. Like you don't get a dedicated investor whose full-time job is to help your company. You get the help of the individual who, if they're a founder, has a full-time job that is to run their company, and so helps you sort of part-time, but can be very, very strategic and very helpful. But that's generally how most scout programs work. And if you want to find them, you can often look them up on LinkedIn.
Yeah, and I would probably think about the scouts somewhat similarly to the way you think about your angel investors. In fact, many angel investors just are funded by scouts. Typically, the firms don't want you marketing that like Sequoia invested in your seed if it was a scout with Sequoia money, which is totally reasonable because that sort of overstates like the firm's involvement. And the only term I think I've seen in our group of angels, we've been connected to a lot of different scout programs. The only terms I've seen founders, some scouts programs want a pro rata allocation so that the firm has access to the future round. I think that's not standard. And so that's a place that you can always push back or negotiate. And then the other area is just if there's a lot of informal information flow in Silicon Valley. And so I've seen some people say, I'd rather wait to be on the radar of the firms until like I'm a little further along. At the same time, most of these folks are really excellent. And so having them associated with your company and having that like sort of one hop away connection to a firm can just be really nice too. So I don't think there's a ton of downside, but those are the couple things that I've seen some folks push back on.
Yeah, I'll give my first disclosure is I am a scout, but before you get too excited, I am a very small scout. So I was the first money into a couple companies, and my first money in was I wrote a check for $100. Literally $100 because it was a woman friend who was really struggling with fundraising. So I said, I can be your first money in, use my name a lot. Don't tell anybody it was only $100.
That's so great, Edith.
You know, the first check is always the hardest. And I honestly
Edith is such a boss.
I didn't have any money back then. And my second check-in was a similar situation, woman founder, and I had a little bit more money then, and I think it was 1,000. And Bloomberg heard that I was doing angel investing. They're like, hey, can we give you a fund? And so I have like a 250K fund now, but my intent is to really write really small checks to people I believe in. And so if somebody's like, well, who the scout is going to get me connected and I'll get a big check, no, it usually doesn't work that way. And to be honest, Bloomberg has already turned down a couple companies that I've passed on to them. Is not a fit. So I think a scout is good if it's like somebody you're connected to, somebody who believes in you, somebody who can then use their network, but it's not usually somebody who's going to put in, that $500,000 or even lead around per se.
That makes sense.
Yeah, I'll do one last plug for the Scouts program. The one thing that's amazing about the Scouts programs, as we've, of our hashtag Angels group, I think we were connected to 4 or 5 of them. In the last few years, that has helped give like financial resources to a lot of people who have the skill sets and the interest and the drive to be angel investing, but just don't have the money. Because I mean, that's the the elephant in the room in terms of like who's able to do this stuff and who's not. So I think they've been good for giving access to a slightly broader group of people to be able to be a part of this ecosystem.
Yeah. I think some firms, including Sequoia, also think about it as a way to reach into new networks of like especially underrepresented minorities. So I think in general, investors are about 9% women. Sequoia is like 22%, so better, but still not great. But we don't have any African-American people on our team. So for me, when I thought about who do I want to make a scout, like 30% of the scouts that I work with are like personally at Sequoia are Black women. And that was important. And it's like a way for a firm to reach into new networks. And so that's a scout might also, especially because we had some questions about underrepresented minorities, like that might also be an interesting angle into meeting more firms.
I love that.
And people said like, which firms have scouts and how do you find them? I don't know if you guys have a list, but I think Jess had mentioned like, I think if you just search scout, like, or, angel investor scout, like on LinkedIn, like people will come up for the different programs.
And some people call them venture partners. It's kind of the same thing. They're like kind of part-time investors. Yeah.
Okay. So, going back a little bit to the topic of like how much to raise and that kind of thing, like someone asked, like, what is the typical range of the total raise amount for, like, I think for pre-seed or seed, and then also what is its typical valuation? So I think we talked about like how to set a valuation. I think like a big takeaway is like talk to other people and see like what other people are raising at. So I liked meeting with other founders that have raised recently, like what, where were you in terms of your traction and what did you raise at? And if you do that with a bunch of people and then you're like, this is what I'm thinking, what do you think? And then you'll start to zero in on something that is market. So that's like a general thing, but so you should do that. But I think for us to give you a little bit of a sense of what is the average size and valuation these days for pre-seed and seed. Give a rough idea. What would you guys say?
To a few million.
Yeah. So pre-seed and seed are fuzzy. I would say pre-seed kind of anywhere from like 100K to like a million, even 750K, a million. Some people skip the pre-seed because they know enough people that they can raise a seed right away. So that could be up to like usually 1.5 to 3 million. But we live in crazy times right now, so some of them are even bigger. So I think that's sort of the range. And then at each of those stages, to give you the valuation, you divide by the percentage dilution. And so the pre-seed, it's 7-10% maybe, and then at the seed, 10 to 20, and then or altogether seed and pre-seed, because it kind of like this like loosey-goosey spectrum is usually 10 to 20%, right? So you can get the valuation by taking the amount divided by the dilution.
That makes sense.
And then the safes and the convertible notes are usually, I usually only see them at the seed and pre-seed stage, and then once you switch to A, you start to see the term sheets and the priced rounds. Although some people do price rounds at the pre-seed and seed stage. Just kind of depends.
So I'm going to sound like a Miss Doom here, but a really common mistake I see people make is they think they get their seed round and they're done. Like, it's like, woohoo, I have my $2 million, I'm done. Like, the investor is giving you this money because they want to get a return on it. And so if you're like, I'm just going to take this 2 million and then just kind of futz around and never raise money again and just kind of coast, it's not going to be a good relationship with your investor at all, like at all. The investor's goal is to get you in a position where you can raise your next round. If this seems really scary and it's not the path you want to take, know that. Where I've seen companies go dramatically wrong is when they think, I raised my $2 million round, I'm growing 10% year over year, why can't I get more money now? And then it's a serious discussion about, like, this is not actually a venture backable business if it's not growing quickly.
And the right amount to raise is not like the maximum I can possibly get at this point in time. The right way to think about it is like you're trying to run a business and you have a set of milestones you would like to reach in the next 18 to 24 months, right? And so how much money do you need to reach that milestone? And maybe there's a base case where you only need 500K and then you prove out something that could get you to the next milestone and you only need a few people. And if that's true and maybe you have a very capital light business, then you should raise sort of whatever that amount is plus some sort of buffer of 50%. So in case like things don't go as planned, which they never do. Then there's if you run a very capital intensive business, like maybe you're opening a physical store or making a physical product, you have to pay for inventory, then you probably need to raise a little bit more. But just don't think about like, what can I get? What is a typical amount? Like think about you run a specific business. What do you need to prove out a particular milestone? What's the best case scenario? Like what could you get to if you raise 2 million? What could you get to if you raise 500K? And then what's really the right amount to raise?
Yeah, 100%.
Yeah, I think those are both great points. And yeah, and keeping in mind that like the investor is thinking about like what percent ownership, like are they getting, like, and whether they're giving 500K or 600K usually matters a lot less than like if they're targeting 10% ownership or something like that. I kind of wish that I understood that better when I was fundraising and sort of did what Jess said, which is like how much do I need, and therefore and how much ownership am I willing to give up, and therefore like that's what should set the valuation. And I think investors can really talk in that language if you talk in that language. I think if you're just like, I think we're an 8 because I don't know, like we're good, like, you know, and you don't really, versus being like, we need this amount, this is what I'm comfortable with, like that's like people are really comfortable having that discussion. But to give people like a really, yeah, you guys gave a rough sense of like size of pre-seed and seed. In terms of like valuations of pre-seed and seed, I can throw something out and maybe you guys can react to it, but I think pre-seed, like pretty low would be 3 million. That's sort of like you're, you know, really trying to just make it really attractive. I think up to maybe 8 would be like pretty aggressive for a pre-seed that's sort of like not a lot of traction and you're not like a serial founder or something like that. And then maybe like a seed where maybe you have more traction or something is, or just you're able to tell the story and raise a seed right out of the gate. Maybe from 6 million to 15 or 20, like 15 or 20 is like, I'm a serial founder or we have like really crazy traction or like some pretty incredible thing. I think 6 to 10 would be more, 6 to 12 is more norm. What other people jump in. I'm just trying to give like a general range, but you should still do the thing of like doing comps of other people to get it exact.
I was going to give some very tactical advice, which is at the early stage, you should have a very simple spreadsheet, which is money coming in and money going out. what are the salaries of people you're paying, you and your co-founder, your early employees? What else are you spending money on? Like if you have a budget for advertising, if you have a co-working space. And this should also feed into how much money you're trying to raise in terms of like, okay, I know that I need to hire a really good marketer and a really good salesperson, and they cost in my market 130K, which is not San Francisco, by the way, but some mythical other market. Like, have this spreadsheet going in so that, okay, when I raise $2 million, this is how far it's going to take me. And that can really influence the size of how much you raise if you know that, like, hey, I'm actually very hardware intensive and I actually need to spin up, as Jess said, I need to lease a restaurant that needs a minimum capital investment of $1 million. That will influence the size. But like, go in knowing how much the money will take you.
Yep, that makes a lot of sense. Okay. Okay, so several people have asked a question around raising from investors outside of the US. So either the companies outside of the US or the investors outside of the US. I don't have a lot of experience with this. Does anyone on the panel have thoughts on this?
So I only know a little bit about raising money in China and India because Sequoia also has a team, Sequoia China and Sequoia India. The markets are all a little bit different, but the investing process and sort of what we think about is fairly similar with some localized differences. I mean, it just kind of depends on the country you're raising in, but a lot of countries, especially China and India, have like established venture ecosystems where people are willing to take on, like they know like this is a risky proposition, like I need to swing big for like a big outcome and I'm willing to put capital at risk and know that like 90% of it will go to zero. And then there are other markets that are a bit less developed where people are not as willing to take risk. So, and this is actually also true of some of the other cities in the US where you'll see that the appetite for risk is a lot lower and people like want to, they're not shooting for you to get to a multi-billion-dollar company. They're like, it would be great if you could sell for 100 million and then I get my money back and I want to be sure to get back my money 50% of the time. So it just really depends on how developed the startup ecosystem and the venture ecosystem is in each city.
I've definitely noticed more like Bay Area VCs that are also there. I think there are a bunch of Bay Area VCs now that are investing in Latin America. So I think especially like observed with sort of, I mean, I'm not saying with things bad, but like some of the sort of like micro mobility or like last mile type, like the scooters, and I think there have been some categories that have sort of like catalyzed more VCs flowing into America. So I think I saw in the chat at some point some people in Latin America. So I think you can do your research on targeting VCs out here that are interested in investing in the geography.
Cool. Okay, another question. Does it matter what partner in a VC we pitch to? Is it the partner or is it like all the partners that end up supporting you?
Usually you end up with one person that is sort of dedicated to your company. So it does matter who you speak to. I think it depends on the firm. Some firms are very like weird and territorial and whoever sees it first, like, that's mine. You can't talk to anyone else. And then some firms like ours are more like, who's the right person for you? Like if you're doing something in social consumer, you should come, maybe you should talk to Jess. If you're doing an e-commerce business, it's very difficult. You should talk to Alfred because he was the COO of Zappos and he knows more about that than anyone. So it really depends on the firm, but I would say it is kind of important who you speak to first. So I would try to sort of get your way to the person you're most interested in if possible. But just know also some firms have like partners who take board seats and then associates or principals who don't and who do the sourcing. So in some firms, you may have to get through the associate first in order to get the meeting with the partner. That's not true here, but some firms are like that.
That makes sense. Yeah, I definitely second the thing of like trying to get in with the right person, because as Jess said, like ideally, if even if you get into the wrong partner, they'll forward it. But like if it's not up their alley, they also just might not think it looks interesting, and then they might turn you down. Whereas someone else might have, like the right partner would have taken a meeting with you, and it's hard to come back from that. And then the other thing is, yeah, I'm open to I'm curious what other panelists think, but I personally think you should not take meetings with associates. I think frankly, I think it's a sign of confidence to try to go straight to the partner, because founders that are like raising an aggressive round, that are getting a lot of interest, like they're not going to have time to go to the associate. They're going to go straight to the partner, and ideally you can get like an intro to the partner or something. I think, I'm not saying never do it. Like if you have no other options, it's the firm, or if the partner introduces you to the associate to talk to first. But I think the way that I think about it, partly it's like a confidence image thing of like, I think it kind of looks less confident to go through the associate, but it's also like you need to get through two filters. Like, you know, a very low percentage of people are gonna want to invest in you in anything. And so if you go to the associate needs to like be really excited and want to invest in you. And then the partner needs to as well. It's like two filters, and the partner might have been interested in the associate, screened you out. So that's my take on it. But what other people think?
I always thought of the associate as your champion at the firm, and that I totally agree. If you can get to the partner you want first, that's awesome. I was not always that lucky. Mm-hmm. And then if you get an associate and they think what you're doing is cool, they're like your secret ally. They're like giving you all the scoop. They're like, here's how to position yourself. Here's how to do this. Here's how to do this, because they want to look good. They want to be like, hey, I found this great company and I'm bringing them to the firm. So if you do get bounced at associate, do not despair. Just think about like, how can I figure out how that associate can help me? Because I mean, ultimately that's what they're trying to do to build their own career, is bring in great companies.
Yeah, I agree. I think the most important person is to get to the person who's most likely to be a champion. And sometimes it is the associate, especially if it's like an all dude firm, like with one female associate who like actually understands you or your problem space. It may actually be best to go through the female associate, or the associate who understands like whatever your space tech company because they were an astrophysicist, whatever the thing might be.
Okay, awesome. Okay.
Yeah, I agree.
Oh, go ahead.
Oh, I was just saying, one thing you're probably hearing is just how much variability there is in the industry. So like it's, you know, at some firms, spending your time with associates might not be like as productive as finding a path to the right partner. But for better or worse, there's just not a total industry standard on this. I think the other thing to just be aware of is when you're talking to folks, just making sure you understand who the ultimate champion is. Not every partner writes checks. Not every partner takes board seats. And so just making sure you understand and ask, like, can you walk me through your decision-making process? How do you all typically invest? Is it common or necessary for you to take a board seat? This is more common at the Series A and beyond. But feel free to ask that stuff up front, just so you understand if you're actually talking to the real champion, or if that person is like a proxy for someone else.
Yeah, especially at the seed stage when there isn't like a board usually. Sometimes the associate becomes the person that works with you most closely, and then that person, an associate will hustle really hard to prove themselves to their firm. And so in some cases might actually be more useful than the partner who's like 30 years into their career and just goes golfing all the time and doesn't answer your emails. Everything's so people and firm dependent, like Jessica said.
Mm-hmm. Yeah. Makes sense. Okay. And then a really important question. How do you deal with severe burnout and exhaustion? It seems like you can't stop or take a break, as it will hurt the progress of your company.
Oh my gosh.
What?
How do you burn out?
Oh, burnout.
Oh man.
How do you deal with burnout? It seems like you can't take a break or it will hurt your company.
So it's funny. So I'm an ultra runner. Everybody says it's a marathon, not a sprint. I do 100-mile races.
Wow.
Edith, we have got to meet. I am also an ultra runner. I think our future meeting is going to be on the trails.
Like, number one, take care of yourself. Like, there's this myth of like the founder not sleeping. Don't do that. Get some sleep. Like, if you show up at a meeting looking exhausted and, deranged, it's not going to get you funding. So like, number one, get some sleep, get decent meals, Take care of yourself. Timebox fundraising. I said this before. Timebox fundraising. Have a sheet. Treat it as a funnel. Like, not everybody's going to say yes. You need just to get the couple yeses out of the rest of the no's. And I forget who said it before, but really manage your own psychology and find a group of peers going through the same thing. Ideally within 6 months of you, so 6 months ahead of you, people who are fundraising the same amount of money. So you can trade stories and be like, okay, this is just normal, or okay, this was crazy. But at least somebody who you can bounce ideas off of. Because like your non-founder friends or your boyfriend or your spouse will not understand it so much as somebody who's in your cohort.
You being in a healthy mental state is actually for the good of the company too, right? So you do have to definitely take the time to invest in like taking care of yourself. Like everybody needs self-care. Everyone needs to figure out what that ritual is for themselves. Like maybe it's vacation, maybe it's vegging out and watching Netflix, maybe it's like yoga or ultra marathon running. For me, I found yoga really helpful. And then I vegged out a lot. And there was actually this one time I felt like I was going to burn out. It was during our acquisition process, which was like the most stressful, right? The worst. And so I just decided I'm going to disappear and I'm just going to lie. Like I literally laid in bed for 3 days and watched Netflix. I didn't do anything. Like literally, I like didn't even get out of bed for food. Like my boyfriend just brought me food and I just like did nothing. And I was like, you know what? I deserve this. It's fine. Like I'm under this incredible level of stress and like, I'm not going to do a good job at this acquisition if I like can't move. And so I'm just going to take this time and like sit in bed for 3 days and watch Netflix and then got back up and brushed myself off and went back to work. But it's okay if that happens every once in a while. And I think Jessica, I've heard Jessica tell the story of that happening when she was on the M&A side and like a founder like disappeared off the face of the earth. And it's just like, it's so hard. Like you have to give yourself a break and you have to really take the time to invest in like making sure you feel good because that matters for the company's health too.
Yeah.
Awesome. Okay. Well, I want to pause and I want to thank our panel. I also want to introduce Pam, the CEO of Allraise, was actually listening in. And hi, everyone. I want to say welcome to everyone or say a couple words.
Thanks for inviting me to be part of your journey and listen in today. I'm excited to continue for the next 2 weeks. I'll try to be listening in and joining as well. And I think the advice you've been giving is great this evening, and so glad to be part of your journey.
Awesome. Thank you so much for the panelists. You guys are so busy, and it's 3 hours is a big commitment. So we really, really appreciate you taking the time to pay it forward. And thank you everybody for joining. I'll be sending out the video recording. And we will see all of you next week. Next week, we're going to be covering how to make a great pitch deck and a great investor blog. So,
thank you to Felicia who puts in alongside running this like amazing company, like spends all this time putting together this program. Like Felicia, you're just like a gift to all women and we love you.
Oh, thank you so much. I love all of you guys.